we do feel like we're getting closer to reaching an inflection point, but it's not clear which way the economy is going to break.
Consumerism is very strong right now.
We think the consumer is actually really well set up here.
What won't likely validate the Fed's 50 basis point cut will be how good the consumer continues to do.
The consumer is moderating. It's not a terrible thing. This is what we were hoping for.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming into Friday at all-time highs on the S&P 500. What a week in this stock market. Equity futures right now on the S&P, little changed. On the Nasdaq, we're down about 0.2%. One market where it's anything but little change this week. Check out China. 8-day winning streak on a CSI 300. This week alone, up almost 16%. Alibaba up almost 20%. LVMH up 18%. Rio Tinto up 10%. Bank of America this morning. It's a bubble dream.
Basically, what we're looking at is bazookas firing on all sides, or at least that's the feeling that people have. The latest being from China, which is sort of the last shoe to fall. People wondering when they were going to come out and actually pledge to stimulate the economy. The Politburo coming out, calling on the population to earnestly enhance the sense of responsibility and urgency of doing economic work well. Now we have a big rally in asset markets. Let's see if the economy can follow.
The markets are waking up to it. The CAC 40 in Paris, France this week up by 3.5%. It's quite a run in Europe.
It's a huge injection for Europe because they are so reliant on selling these goods into China. Europe is only going to do well if China does well. So when you have the Chinese coming out and saying that it's necessary to respond to the concerns of the masses in China or the masses in Europe, on top of that, the European data today in two countries, France, showing inflation actually falling. Everyone is now starting to think maybe we will get another ECB rate cut. It feels like this potentially is going to help lift Europe.
Not just France, Spain as well. Euro dollar right now, 111.62. We've talked about it all week. The output, the growth backdrop, not great. Inflation south of 2% in France, in Spain. Are we getting closer and closer to another rate cut of the ECB? It sure feels like it.
If they don't cut rates, what's wrong with them? That's sort of the feeling that we have in markets. An 80% chance of a rate cut at the October 17th meeting. Basically, you have inflation falling below that 2% target in both France, in both Germany, across the Euro region. A real question here. Why wouldn't they? And if they wouldn't, how much does this actually end up torpedoing growth in a way that's going to be negative for the euro anyway? That, I think, is an increasing feeling in markets right now.
That's euro dollar. Let's talk about Japan and dollar yen. Dollar yen 143.11. This is a real gap lower by 1.2%. Japan's ruling party picking its next leader, and its next leader is a backer of the BOJ's effort to normalize policy.
And the fact that there was such a rush into the yen, into strong yen bets, really shows just how much this is going to matter. Basically, the next leader potentially is going to be Shigeru Ishiba, who backs the idea of normalization. And just that alone really puts the thumb on the scales of possibly hiking rates yet again. Again, this just speaks to how the door is open to a normalization across the world.
We're talking about what's going on in China, how they're having this massive uptick when it comes to equities. Then you talk about this new prime minister entering Japan, someone who potentially is keenly focused on the geopolitical concerns and what China is doing in the Indo-Pacific. This is someone that is backing the idea of an Asian NATO. And I think amongst all this high of the equity markets, you're kind of missing some of the security concerns happening right now.
Dollar yen right now at 143. If you are just joining the program, welcome to the show. A lot to work through. Equity futures on the S&P 500 down by close to 0.1%. No drama here. Yields are lower by a single basis point. The 10-year still in and around 380 at 378.79. Coming up on the program, Marvin Lowe of State Street saying the Fed put is alive and well. Bloomberg's David Gura as New York City Mayor Eric Adams prepares to appear in court. And Amrita of Energy Aspects on the prospect of a crude market share war. We begin this hour with stocks heading towards a third week of gains on the S&P 500. Marvin Lowe of State Street staying bullish, writing this: the Fed put is alive and well. The Fed's willingness to start with a 50 basis point rate cut, while remaining data dependent, essentially hands the market the option to push the Fed towards 50 on any sign of economic weakness. Marvin Lowe joins us now for more. Marvin, I've said this a few times over the last week. Does it get much better than this?
You know what? It's a pretty good time right now with the stories coming out of China, certainly. The global cutting cycle and discussions that it might accelerate is just good for risk assets. And, let's not look that gift horse in the mouth.
Marvin, the miners are up, luxury's up, Chinese tech is up by almost 20% so far this week. We've seen this movie before. You get hints of stimulus out of China, we rip for a little bit, and then we roll over. Is it different this time?
You know, it's pretty significant. Certainly, it does seem as if the central government is looking to stabilize at least the economy through the financial markets. It's a real question to us whether or not, similar to whether or not Wall Street can make its way into Main Street, whether or not these actions can once again drive a more active consumer that has really had problems feeling comfortable with the economic situation there. So that's to be seen. But from a market's perspective, this certainly is supportive.
There's a broader theme here, and this, I think, is what really got people's attention this week, which is maybe the market underestimated just how much the Fed's cutting cycle would open the floodgates to the rest of the world also taking easing steps. How much is that what we're seeing and basically paving the way to a global easing cycle that really fuels more growth than people previously expected?
You know what? I've always been of the thought that while everyone expected the Fed to cut, it really took a view of how the cycle was going to evolve in their minds, in the FOMC's minds, to get investors comfortable with how that might domino through the rest of the world. So, yeah, there is a bit of that, even though everything has been, fairly well priced. A looser monetary policy coming out of the U.S. just makes it a lot easier for the rest of the world to ultimately follow along.
Is it now just a potential policy error waiting for the ECB not to hike, not to cut rates in tandem with the Fed more aggressively, just simply because they have inflation below 2%, they have growth rolling over, they've got a whole host of potential challenges. There is no argument for them to keep rates where they are. Am I missing something?
Yeah, no, I agree with you completely. What is going to be interesting, I think, as we go into next year, are potential changes in R-star, kind of, if you will, this neutral rate, where in Europe, it looks like their R-star could potentially be lower than what it was before the pandemic. Where in the U.S., we're still debating whether or not kind of this 2 7/8 neutral rate, which is, almost 50 basis points above where it was before the pandemic started, makes sense. Does it need to be even higher than that? And that's kind of the monetary policy dispersion that we had been expecting really for the last year and a half, which is now finally playing out.
Marvin, leaving the ECB to one side, how promising is it for Europe, basically only dependent on how well China goes with these new stimulus measures?
I mean, for sure, we have to look underneath the covers there and wonder what that economy looks like. It's, again, part of that R-star discussion I'm talking about. It's Germany's really real inability to kind of get out of its doldrums. I do think it is a sick type of economy that takes a lot more than just this one sugar dose. It'll help for sure, but there's still a lot of underlying concerns.
How difficult is to understand the German economy when you see the headlines coming out of, say, the auto industry, but then you look at where the DAX has been trading?
Yeah, I mean, for sure. Again, it's the separation between Wall Street and Main Street to a certain degree. Germany has really benefited from a pre-pandemic world, which was much different from a geopolitical perspective, which is, certainly impacting Europe a bit more than it might be the U.S. economy. And we really need to think through that as a potential headwind as we go into an environment where geopolitics potentially becomes a much higher headline concern than it really had been in the mid-2010s, if you will.
Okay, putting aside potential geopolitical shocks, you are potentially much more bullish than you were, say, a week ago. Is that an accurate characterization?
No. I mean, I really did feel that the cutting cycle was something that was underappreciated. I do think that the tailwinds globally is pretty significant. So, I've liked stocks for the better part of the summer.
Okay, so you've been bullish for a while. That's what a lot of people have been saying. They're getting more bullish as the cutting cycle goes on. Maybe you've always been this bullish. People are saying get out of cash. It is the time to start going into other assets, into stocks, into longer term bonds. Yesterday, we got data from ICI showing the biggest weekly inflow into money market funds. Jerome Schneider yesterday of PIMCO is telling us this is not really going to be the best place to be. It is actually accelerating the flows into these asset classes. $6.4 trillion now in money market funds. How do you explain the fact that people are still rushing to cash at a time where you're hearing the increasing cries to get out?
Yeah, you know what? We were having that exact same discussion on the desk yesterday. There are a lot of things that don't necessarily package well in terms of the flows and liquidity. I do think it speaks to the amount of liquidity that remains in the system, which ultimately is supportive until we really start to worry about liquidity, if you will. At the same time that's happening, we've got this Treasury conference that's going on at the New York Fed where they're talking about thinking what the liquidity situation will look like as QT kind of goes on. So for the moment, it is a tailwind. There is a lot of liquidity in the system. I think it speaks to the growth that we have in the U.S. and that potentially either supports retail and or supports the market. But QT will continue to operate in the background given that there's so much liquidity out there. And we do need to think through into the second half of 2025, which feels like a lifetime away, when maybe all of these tailwinds we have really start to die down.
2025. I think we've got to talk about the policy anxiety around the election. Marvin, do you think we can avoid that kind of gap lower in the equity market as we anticipate what may or may not happen November 5th?
I mean, you know what? There's so much that's going to happen in early November. You know, certainly the elections, hoping that we actually have an answer, if you will, after the elections. The Fed is that week also. You know, the risk that I would look at in terms of top priority to you know, getting a little bit lesser. Number one is whether or not we can call you know, who the president is comfortably. If we can't, that is an absolute risk premium that the market needs to absorb. In terms of policy itself, there's going to be a knee-jerk reaction where Democrats are viewed less you know, less cooperative to the markets, if you will. But policy itself that gets put in place, you know, I think we need to figure out who Congress is and what they can actually get done. If anything, really the deficit discussion remains top and center, however, as we go through this, which really formulates how you want to look at longer Treasury yields as we kind of go into the end of the year.
Beyond the bond market, though, Marvin, I think this raises really important questions about the character of the current rally. We've seen China absolutely rip this week. How vulnerable would it be, this rally, to a Trump presidency come November?
Oh, you know, for sure. Again, I do think that a lot of what we're seeing in China is market supportive, but not necessarily economically supportive. We've had head fakes before. It takes the real economy in China getting firm footing to really justify the kind of rally that we've been seeing.
Marvin, enjoyed this. Thank you, sir. As always, Marvin Lowe there of State Street. Goldman Sachs, Kristen Muller-Glissman, this line. Bullish US equity positioning and optimism might be tested by elevated policy uncertainty. What's ripping this week? China. What could test that? The US election.
Especially if you end up with a real protectionist type of policy that requires a real nationalistic response, which is the reason why some people were surprised that this really did come out when it did. It strikes me there are three big questions emerging from this week. How far are policy officials willing to go? How much does this affect the real economy? And how strong or weak is the actual economy right now? That's true of China and that's true of the United States.
Right now, things are all good. Michael Hartnett, Bank of America, called it a bubble dream. The Fed is slashing, oil is crashing, China's inflating. The world stock market cap is set to surpass the high back in October 2021. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. Shares of Costco are falling in the pre-market, down more than 1%, even though the company reported better than expected profit in the fourth quarter. The retailer said shopper traffic during the quarter increased in the U.S. compared to last year, but visitors spent slightly less per trip. Costco has had quite the run this year. As you can see, shares are up nearly 37% so far. Meanwhile, Intel apparently turned down ARM Holdings when the company asked about buying a unit of the company. Bloomberg has learned ARM approached Intel about buying the struggling chipmaker's product division. Intel's response, it's not for sale. Intel was once the world's largest chip maker, but has become the target of takeover speculation since a rapid deterioration of its business this year. Meanwhile, Hurricane Helene made landfall on the western coast of Florida last night as a Category 4 storm with maximum sustained winds of 140 miles per hour. Power Outage US reported that over 1.3 million homes and businesses are without power across the southeast. The hurricane's massive size means it's likely to bring torrential rain and flooding to cities hundreds of miles away, including Atlanta and Asheville, North Carolina. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the programme, domestic divisions over Ukraine.
There are some in my country who would instead force Ukraine to give up large parts of its sovereign territory. We will continue to provide the security assistance Ukraine needs to succeed on the battlefield.
We'll get to those divisions up next on the programme, live from New York City this morning. Good morning. US equities just off all-time highs as the rally continues worldwide. Equity futures negative here by 0.06% in the bond market, just about unchanged. Your 10-year, 378.67. Under surveillance this morning, domestic divisions over Ukraine.
The United States supports Ukraine not out of charity, but because it is in our strategic interest. There are some in my country who would instead force Ukraine to give up large parts of its sovereign territory, who would demand that Ukraine accept neutrality. We will continue to provide the security assistance Ukraine needs to succeed on the battlefield.
So here's the latest this morning. Kamala Harris pledging full support for Ukraine following President Biden's announcement of an $8 billion aid package, drawing a contrast with Donald Trump, as the former president suggests Ukraine should have offered concessions to Russian President Vladimir Putin. Joining us now is Bloomberg's Greg Cordy. Greg, let's get to this. The meeting later on today and the tension between the Ukrainian leader and the former president of the United States.
Yeah, this meeting is about 3.5 hours from now at Trump Tower in New York. And it comes after a week in which, obviously, we have world leaders coming to New York for the General Assembly. Zelensky also taking the opportunity to engage in a little bit of domestic politics, going to Pennsylvania, a key swing state, perhaps the key swing state in this presidential election, going to Scranton, where they build ammunition for the Ukrainian war effort. Donald Trump took that as a personal offense. He's got his allies in Congress now opening investigations into whether that was proper. And so this is a very tense relationship. Trump has accused the Ukrainian president of being untoward to him. And so there's going to have to be some de-escalation here. Zelensky knows there's probably a coin's flip chance of either one of these two people, Kamala Harris or Donald Trump, being the next president of the United States, and he's got to work the relationship no matter who gets elected on November 5th.
Greg, it almost feels like Zelensky is not reading the same polls you and I are reading. And the issue is not just with the Trump camp. How much does this hurt Ukraine's chances with Republicans in Congress, that regardless of if Trump wins or not, they are going to need those Republicans' support to continue the aid flow?
Yeah, and that's exactly why you see these world leaders, whether it be Zelensky, certainly Benjamin Netanyahu, being very sophisticated in how they play the domestic U.S. politics here. And they usually try to walk this tightrope of trying to cobble together a bipartisan consensus. That bipartisan consensus has fractured over Ukraine. This Republican Party, post-Trump, is a lot more isolationist, a lot more Eurosceptical than it used to be. And so he's got his work cut out for him if he's going to earn even those more traditional Republicans, not to mention the J.D. Vances of the world, Trump's running mate, who is perhaps the premier Ukraine skeptic in Congress right now.
Which Zelensky told The New Yorker he is an individual that he finds too radical, unnerving, again, the Trump campaign. But we just have a new Bloomberg poll out, Gregory, which I know you pay a lot of attention to. You read all the responses. How much is foreign policy actually landing with the electorate?
Foreign policy tends to rank lower on the list of concerns of U.S. voters when you just sort of ask them to list their issues. But on each of these foreign policy issues, if you ask about China, if you ask about Ukraine, if you ask about the Israel-Hamas conflict, which of course we know is now escalating to another front with Hezbollah, voters tend to trust Trump over Harris on every one of those. Again, sort of reflecting the more isolationist mood that you have here in the country. And so it is something that, look, Harris, as the incumbent vice president, doesn't have the same sort of room to kind of politic on this. She is wedded to the Biden doctrine on each one of these fronts. And so that gives Trump sort of free rein to be critical of U.S. policy on this and to sort of look for votes there.
It's interesting this is all coming at the UN General Assembly week, where suddenly there are all these world leaders, in particular from Europe, that Ukraine very much views as their allies. How much are they refraining from making some of the statements that Volodymyr Zelensky is making in order to kind of hedge their bets? Because there's a real razor edge kind of election here taking place in the U.S.
Yeah, it's a very, very difficult relationship to manage when you don't know who the next president of the United States is going to be. You see Western officials, Keir Starmer now, meeting with former President Trump over lunch, trying to find some common ground, even though those two men are very far apart. This is a Western world that is grappling with the prospect of Donald Trump returning, and they're all sort of befuddled and trying to figure out where they stand. They survived the first 4 years of Trump and how that really disrupted some of the key underpinnings of the post-war world order with NATO and the multilateralism there. Now, in an even more perilous environment, given the Russian war, given what's happening in the Middle East, looking towards what a Trump Doctrine 2.0 might look like.
Annmarie was talking about the new poll that just dropped from Morningstar and Bloomberg showing that Kamala Harris is having a slight, tiny lead in a bunch of these swing states. Just how difficult are some of the polls to read, and how sort of muddied has the water become after there's a real question about likely voters and the ones who are most likely to come out, to turn out, versus those who just have a preference but aren't really at play?
Yeah, so obviously there's a lot of criticism about public polling, and it's a very crowded picture. You got a lot of polls out there and some question about how to read them. Polls are actually pretty good. What's changed in the past few election cycles is that our elections are just very, very close. And so we're talking about just points, maybe even fractions of a points of difference. This latest Bloomberg News Morning Consult poll that we just published last night, of the 7 key swing states most likely to decide this election, really shows us the race at a razor's edge. Kamala Harris is at least tied or leading in all 7 of these states. But again, these are all within the margin of error. As you point out, it depends on which one of these people that we surveyed actually shows up to vote. So we're starting to look at likely voters. In this particular month, Vice President Harris does do better among likely voters than she does among registered voters, but that's not a given. And so, look, this is still anyone's race. And we have one more Morning Consult poll that we do with Bloomberg News next month, just before the election, and we'll see where we are there. But ever since Harris got in this race, it has been a virtual deadlock.
Looking forward to the coverage through the next month. Greg, appreciate your time. Gregory Cordy there. Out of the nation's capital, the number one issue in this election has been for a long time, it often is, the economy. The gap between Donald Trump and whoever he's running against has been this wide for a while. It's getting closer and closer on that issue.
Well, which is interesting is Gregory Cordy saying basically Harris has been able to tighten the race. When you look at the number one priority of voters, it's the economy. When it was Joe Biden early July, it was a 14-point gap. Then later in July, when Harris entered, 8-point gap. Now it's at a 4-point gap on the top issue. So she is really chipping away at his lead when it comes to the number one issue, but the trust still remains in his favor.
You can see where the momentum is. I'm pleased we've brought up the Ukrainian president as well. A lot of people have celebrated his approach to diplomacy, and foreign policy is really, really hard, but I don't think you can overstate how badly they have done this week. If you believe this is a coin flip when it comes to November 5th, then this approach isn't the right one.
They fumbled the approach when it comes to the Trump campaign, unnerving them with this interview, then going to the swing state of Pennsylvania, getting a tour by the most probably beloved Democrat in the party right now, Governor Shapiro, who's loved in Pennsylvania. So then you have Speaker Johnson coming out and saying, actually, this isn't fair. Your ambassador needs to go. It's a different tone than he took with me in July. Felt like he really wanted to talk to Donald Trump, and now it just feels like he's snubbing him.
We'll see how things change later on this afternoon. Coming up on this program, Bloomberg's David Gura. As New York City Mayor, Eric Adams prepares to appear in court later on today, facing bribery charges, wire fraud, and taking illegal campaign donations. That conversation up next. Heading towards a third week of gains on the S&P 500, a lift throughout the week. Right now on equity futures, pulling back just a touch on the S&P 500, down about 0.1%. On the Nasdaq 100, we're down 0.2%. The rally this week has been absolutely phenomenal. On the week, the CSI 300, we're talking about gains of almost 16% at the single name level. The likes of Alibaba are up close to 20% in a single week. These are huge moves. I think Freeport here in the United States up by something like 17% so far this week. Rio up 10%. BHP up 11%. It's the miners, it's the luxury players, it's anything connected to China.
Invesco's David Chow saying this: FOMO is running high for investors as Chinese equities have moved close to 10% in the past 3 days. Based on historical valuation, we think Chinese stocks have another 20% runway to go. Basically, there was a wave of cheering unleashed by the Politburo as they say we need to get the economy in a better shape. Let's get going. Let's cut rates. Let's give some stimulus to poorer families ahead of the national holiday. And frankly, it's helping markets a lot. The question, will it trickle down to the economy?
I mentioned this from Michael Hartner earlier this morning over at Bank of America. A bubble dream. The Fed is slashing. Oil is crashing. China is inflating, which raises the question, why aren't bond yields higher? And we'll explore that throughout this morning. Let's check out the bond market together. Switch up the board, turn a page and get to the bond market story. The 2-year, 362. The 10-year down a single basis point, 378.67. Last week, the 2-year was up by not even a basis point. This week, it's virtually unchanged all over again. I get that the front end is anchored. What do you do with a 10-year yield, given the news flow of the past week?
I have no idea, especially because yesterday, talk about revisions, talk about new data. We got data out of the U.S. government showing that the U.S. emerged from the pandemic a lot stronger than previously expected, with the GDP adjusted for inflation upgraded to about 5.5% from 5.1% in the 3 years, and the savings rate actually substantially higher than we previously thought. So if you think that people have plenty more money to spend, and you think that the economy actually went in and came out of the pandemic in a better place, why wouldn't you assume that inflation would ultimately be stickier because this wasn't as restrictive of a rate as people previously thought? In other words, I have no clue. I mean, honestly, this to me is the trade.
Jobless claims, 4-month low. It's been a big story so far this week. Let's turn the page and get to foreign exchange. Two currency pairs. I want to start with the euro. This from Subhadra Rajappa of SocGen. Racing to ease, and the race is on over at the ECB. Inflation in France, inflation in Spain, plunging below 2%, and the euro down to 111.65. Does this tee us up for a rate cut at the ECB next month?
The market collectively says, yes, it is. It is absolutely going to tee the ECB up, given that now we have an 80% chance priced in. Why wouldn't they go? I was asking this before. I can't find the argument not to cut rates for an ECB that is facing disinflation that is greater than they thought previously and more weakness than they realized. That to me seems like a perfect recipe.
There was a great quote out on Twitter, X, just yesterday. It came from Marc-Andre Fonga, and he said the Fed could cut rates further, the ECB should cut rates further. There's a big difference. I like that framing.
If you believe that this is a single mandate central bank focused squarely on inflation, where is the argument right now to not cut rates? That, I think, will be really interesting at a time where it is more political, especially with a fractured set of countries. That said, where is the objection going to come from? Germany? Really? I mean, is that really the one that is going to come up and say, actually, we need to protect the euro and keep the strength and keep rates where they are?
With the economy basically in recession right now.
Correct.
In the largest economy in Europe. Speaking of politics, let's talk about Japan. Dollar yen down to 143. This is a much stronger Japanese yen. That currency pair dropping back by a little more than 1 full percentage point. 143 on dollar yen. Japan's ruling party picking a new leader, and that new leader is essentially endorsing higher rates over at the BOJ.
So wouldn't they hike rates as well, given the fact that that really was what people were waiting for? Key question will be, how much does that hinge on what the Federal Reserve does? Because at a certain point, they want to get the yen stronger. They don't want to miss the window of opportunity. So do they get a chance to strengthen the yen even more in a more constructive way if they hike now at the same time that the Fed is cutting? Basically, this is a global easing cycle that has given the Japanese authorities the chance to normalize in a way that nobody thought that they could without disrupting global order.
And because of that move, Japanese stocks missing out on the rally. Under surveillance this morning, a top story for you. Israeli Prime Minister Benjamin Netanyahu agreeing to hold talks about a ceasefire in Lebanon. The US-led proposal is seen as a last-ditch attempt to prevent the conflict from escalating further.
So what Netanyahu said yesterday at the UN than what his office put out on X and Facebook in English is very different. It seems that Netanyahu's under a tremendous amount of pressure. We know that Ron Dermer met with individuals from the Biden administration like Brett McGurk and Amos Hochstein here on the sidelines of the UN. But this is what the statement was from the office. Israel shares the aims of the U.S.-led initiative of enabling people along our northern border to return safely. Basically, we share the aims of this potential 3-week ceasefire. Very different than what he actually said at the United Nations. So it remains to be seen, is this a flip-flop, or are the Israelis really on board with potentially this ceasefire?
When you talk to officials in the U.S. government who have talked with Netanyahu, they say it really depends on which Netanyahu you get, depending on which day you speak to him and what he is going to say. Unclear exactly where this is going to go. It's more interesting to me, based on the fact that there is a lot of flip-flopping going on, is that Iran has not gotten involved in terms of directly fighting Israel. And that is notable. It isn't trying to escalate the conflict and back up Hezbollah. It kind of shows the reluctance for a lot of players to get more entrenched in this just now without trying a couple of levers.
Would you say, though, that this is a real shift in the stance, a real softening from the Israeli leader?
For now. Maybe.
You're questioning whether it sticks?
There is an ultimate feeling that they want to get people back to live comfortably in the north of the border. How do you do that? How do you achieve some sort of buffer to prevent an October 7th from happening? How do you end up with so much anger and saying, why do we have, missiles pointing at us? At the same time, how much appetite is there to really make a ground operation after being in Gaza as well? Maybe it's a shift in stance, but as we heard yesterday from our colleague in Israel, this is a bellicose nation right now that wants to fight back.
It really annoyed the White House. I mean, Admiral Kirby keeps his cool. This was what he said yesterday. I don't know why Netanyahu said what he said, and I don't know what his considerations were, whether they were political or operational. Ask him why he said that. They're annoyed.
That's a real drama in the Middle East. Let's get to another drama. I've called this a soap opera in European banking. Commerzbank set for its first meeting with the Italian banking giant Unicredit later on today, with talks ramping up for a potential takeover. Commerzbank pledging higher profits and shareholder payouts despite the German government's opposition to the deal.
So basically, everyone's saying probably this is a deal that's going to get done. My favorite aspect of this is this basically calling the German authorities' hands and saying, you cannot like it, but it's going to go through. You cannot like how they did this, but guess what? Everybody else thinks that it's probably going to be the best thing for them. Is this basically the path of travel for consolidation in a Euro region that's highly politicized, but ultimately one that needs to really have tie-ups in order to continue with health?
Giorgia Meloni, Olaf Scholz had a call, and apparently this was not part of it, which I find interesting because we heard from the Italian foreign minister along the sidelines of the UN saying this: Europe, there's a free market. I don't understand why when someone comes to buy in Italy, they say that we're in the European system. But then if Italy buys, it is no longer a single market. There is this double standard that the Italians feel right now, and it's out in front with this deal.
I think if any of us had the opportunity to speak with German officials, you will later, I would show them a chart going up and to the right of Commerzbank. It's up another 5% this week. That should be case closed. The stock is higher. Shareholders are not unsettled by this at all.
Well, maybe the shareholders that are the German government are unsettled, so they're talking for themselves. Question is whether they can actually prove some sustainable way that they are arguing for on their own front to try to support some of the Landesbanks and some of the national champions and keep them thriving.
I imagine the foreign minister will tell me, Annalena Baerbock, that this was the finance ministry's fault, or potentially she'll say you have to go to the finance ministry for questions about that. Sleepwalking into basically what they did not realize was Unicredit buying up all these shares. But what is fascinating is that the finance ministry is held, because, it's a coalition government.
Sure.
It's held by the pro-business, pro-capitalist party. And they're also on board with saying they don't want this to happen.
You could write a book on the last decade on German officials sleepwalking into crisis after crisis that everyone's talking about over and over again, repeatedly. And this is another one they've just kind of stumbled into and are trying to work out what to do next. Let's get to some polling out of the United States. New polling from Bloomberg and Morning Consult showing Kamala Harris taking a razor-thin lead over Donald Trump. Harris making gains across 6 of 7 swing states and closing the gap with Trump on who voters trust more on the economy.
It's worth going through how much he's able to close that gap, and you can see it on that chart there. So Trump's advantage on the economy right now is only 4 percentage points. It was 6 points in August, 8 points in July. That's when Harris entered the race. Before Harris at the top of the ticket, Trump was leading a 14-point advantage. That's why at the RNC they were celebrating this as a coronation, starting picking out who was winning, who was going to get what cabinet seats, because they felt that the economy is the number one issue time and time again for this electorate, and that Trump had such a huge advantage. So she's not winning just yet on the full trust of the economy, but she is certainly edging on that advantage.
And all Democrats are distancing themselves from this guy. New York City Mayor Eric Adams due in court later on today. Adams facing charges of corruption and taking illegal campaign donations. Federal prosecutors accusing Adams of taking improper benefits for nearly a decade. Adams is expected to plead not guilty while vowing to stay in office. He's late to set because he transfers through Istanbul. It's Bloomberg's David Gura. David, good morning. Allegedly. Some of these allegations say they're shocking.
Yes, this is a 50-plus page indictment, and as is the case with a lot of indictments from the Southern District of New York, tells a great story with illustrations. I mean, there are pictures here of hotel rooms he stayed at the St. Regis in Istanbul, the Cosmopolitan Suite and the Bentley Suite. And so, as you say, this went on for more than a decade. It preceded his mayoralty. He was the Brooklyn Borough president and developed this relationship with officials in Turkey in both the private sector and the public sector, according to these allegations. And as a result of that, got a lot of upgrades on Turkish Airlines, got a lot of hotel room stays, and in so doing, had a relationship where the Turkish government could allegedly lean on him to do some things that it wanted to do here in New York.
John alluded to the lack of support that this mayor has right now to stay in the office. We know that Governor Hochul has come out and say, I'm going to look at my options. I hope he chooses an appropriate path. It sounds a little bit like Nancy Pelosi in the interview about Joe Biden when she was talking about whether he should continue the presidency. How much is there a growing momentum for him to step down? And if he doesn't, what is going to happen given the groundswell of anger against him?
So the statement that you're talking about is an extraordinary one in many ways. And so she, of course, nods to the fact that nothing's been proven here. He's innocent until proven guilty. But there is this focus on sort of what she's going to be doing in the coming days and what he's going to be doing in the coming days. But what stood out to me is this line from that statement: New Yorkers deserve to know that their municipal government is working effectively, ethically, and in the best interests of the people. Eric Adams, standing side by side with his attorney, who is also Elon Musk's attorney, a very prominent defense attorney, making the case that this is all fabricated, these are false claims, and saying he's going to fight through this because he's been fighting through the specter of these allegations for many months now. Look, you look at how many people in his administration have left in recent days and recent weeks. I think that there is a really vital question now in this city. Does this administration have the people, does it have the brain power and capacity to continue to run the city? And I think that's going to be something that sways Democrats, not just here in the city, but in the state and nationally as well.
Just to take that a step further, there's a question about if you broaden out the entire web of people who are involved in this, how big is this? There have been a number of people who have resigned from a number of different departments. There are potential allegations of changed outcomes in specific industries. I'm thinking of the fire department and an investigation into the Istanbul consulate. How far-reaching is this at a time where people are questioning the efficacy of the New York City government?
Look, we don't know how broad it's going to be. And of course, there could be superseding indictments. In the New York Times, which broke the story of the existence of the indictment, is out this morning saying that there are subpoenas looking at his relationship with other countries as well. So we'll see how it broadens, if it does, in the coming days. But you look at what ushered him into power in the city back in 2021, and he assembled this broad coalition. That's what he said so proudly of people across the city. He managed to do that through the relationships that he had. It's his style of politics. So we'll see how broad that is. But you're right. I mean, it encompasses a lot of agencies within New York City government. And just looking at the police department, we've had 2 commissioners who have resigned as a result of these investigations, and now a third one who's there on an interim basis had his papers searched a few days ago as well. So it just continues to build and pile on.
David, I don't know if this is a case of Brooklyn versus Bronx, Mets versus Yankees, but Hakeem Jeffries versus Alexandria Ocasio-Cortez, very different. He's coming out and he's saying Adams is entitled to presumption of innocence. He's not taking that fine line of potentially this individual needs to step back so the city can actually be governed.
Yeah, his a tertiary statement, and I think back on Hakeem Jeffries before he was kind of ushered into leadership in the House, rumored to be somebody who could be the mayor of the city someday. That might have been something that he was aspiring to be. But you're right. These are 2 people who've known each other for a very long time. Eric Adams, when he's Brooklyn Borough president. Hakeem Jeffries, of course, representative from the same borough. It will be interesting for me to follow sort of what we hear from Chuck Schumer when, in fact, we do. Another Brooklynite in a huge position of prominence in government as well.
He was asked in Congress yesterday and quickly took out his phone and said, emergency.
Had to flip phone, had to walk away.
Yeah, you know, he always does it. There's always a phone call for Chuck Schumer when, you know, it's useful for him. So what do we expect today from Eric Adams?
So he and Alex Spiro will be at the court on Pearl Street in New York for a hearing, and we'll sort of get a sense there in more detail of sort of what goes beyond these indictments and what the path forward is here as well. But he will be making that a court appearance, and you know, I wouldn't call it voluntary, but he'll be making his way of his own volition to the courthouse downtown.
Do we know if Andrew Cuomo's gearing up for a comeback?
This is widely rumored to be the case, and while I have no reporting myself on that, it is something we have heard widely that he's interested in doing, and he sees this as an opportunity. So, I mean, just going back to what you said about Kathy Hochul, the governor, she has this amazing latitude to suspend the mayor if she wants to and remove him as well. That would lead to the elevation of the public advocate in the city. If we had a special election, I think that there is a former governor who would be taking a close look at his prospects.
I'm not sure how she's going to feel about that.
Yeah.
Wow. Honestly, I'm just thinking, don't we have another bench? I'm just wondering, can we get some people without, I don't know, some hair on them coming into the office?
He is still running for re-election. Eric Adams is, and so there are comptrollers past and present who are running against him. I mean, there is a kind of primary that's shaping up here in the city. So there is a bench. There are people who are interested in the position beyond members of the Cuomo family.
Okay. Good to see you.
Good to see you. So have a good weekend.
You too. David Gura of Bloomberg on the latest. What a drama. Let's give an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. A new warning out for its 737 aircraft. The National Transportation Safety Board said a faulty component on some planes could cause rudder systems to jam. According to the FAA, United Airlines was the only U.S. airline that had the faulty parts. While the agency does not believe the airline is still using the affected parts, it is still urging Boeing and the FAA to address the issue. Meanwhile, Dell is calling its salespeople back to the office 5 days a week. In a memo to employees, executives wrote, quote, "We know situations will arise when you need to work remotely, but working remotely should be the exception rather than routine." A previous memo widely reported earlier this year told Dell employees they would only be eligible for promotions if they showed up to the office. The new return to office policy for Dell starts next week. And as foreign leaders gather in New York this week for the UN General Assembly, our own Annmarie sat down with the French foreign minister to discuss a potential Trump administration and how France would react to his proposed tariffs.
We believe that international trade is a source of welfare for our co-citizens. But we also believe that we need to be firm on reciprocity, and we need to set a level playing field with all our partners. And so I hope that we will not see the beginning of trade wars across the globe, but especially between the US and Europe.
Later today, Annmarie will sit down with German Foreign Minister Annalena Baerbock. You don't want to miss that. That's your Bloomberg Brief. John?
Yahara, thank you. Must watch TV. One question. Are you walking in with a chart of Commerce Bank? Is this how this conversation begins?
Yeah, you know what? Maybe I will bring props. I think that's what I'll do. I'll bring props.
Props for this interview?
Yeah, respond to this chart. That's the question.
With like a stick and stuff? Okay, looking forward to that. Up next on the programme, a market share war brewing in the oil market.
Whether or not there's a $100 price target, I think we'd be somewhat sceptical about that as an explicit thing to focus on. The real problem from Saudi Arabia's perspective is you're going to be in a scenario where non-OPEC supply is going to grow faster than trend demand growth.
Amrita of Energy Aspects up next. You're watching Bloomberg TV. Following the 42nd record high of the year so far, your equity market pulling back by 1/10% on the S&P 500. Yields lower by a single basis point, the 10-year 378.67. In the oil market, things bouncing just a little bit, but still a 67 handle on WTI, 67.93. Under surveillance this morning, a market share war brewing in the oil market.
Whether or not there's a $100 price target, I think we'd be somewhat sceptical about that as an explicit thing to focus on. But if we step back and look at the underlying structural dynamic in the market, the real problem from Saudi Arabia's perspective is that at any price, not even close to their fiscal break-even, any price around where they might target it, you're going to be in a scenario where non-OPEC supply is going to grow faster than trend demand growth.
So here's the latest. Crude oil heading towards a deep weekly decline as more investors bet Saudi Arabia will increase output. The Financial Times reporting this week Saudi Arabia is ready to abandon its unofficial price target of $100 a barrel for crude as it prepares to increase output in a sign that the kingdom is resigned to a period of lower oil prices. Joining us now, Amrita of Energy Aspects. Amrita, we all remember November 2014 is a repeat brewing.
I think you know this better than I do. I think some of those words used in the headline were a bit misleading. I don't think anybody, in particularly Saudi Arabia, have ever said anything about a $100 target. And I do think the concept of market share, or the way it was written, is taken out of context. Look, what Prince Abdulaziz and the countries who have come out with the voluntary cuts have said very clearly is that A, they're voluntary, so they are going to be unwound, and they are hoping that the compensation cuts that are supposed to be coming through will be able to at least partially offset the increase in production. So this isn't about flooding the market. And we put out a note yesterday saying that the focus of OPEC Plus continues to remain on inventories, to make sure that the inventories remain below the 5-year average. And how they manage that between them in terms of who's cutting and who's bringing back production is almost irrelevant, at least from their point of view, because the focus will still be for the group, let's make sure inventories don't build, let's make sure the curve is in backwardation. And I think that's the thing somehow the market has forgotten. Of course, the weakness in demand has made it challenging for them, there's no doubt about that. And I'm not saying that next just miraculously demand is going to be much higher. Having said that, some green shoots, some of the stimulus that China's doing now and the Fed rate cuts will help. But I also think we need to put it into context. I think yesterday's article, of course, everybody's talking about it. I don't think there's a lot of truth to that headline that was talked about. The increase in production, yes, it's planned from December. We have that in our numbers as well, and they've communicated that. So it's not a shift in strategy.
Wait, Amrita, are you saying that they're not going after market share, basically, and they are still looking at supporting prices?
I don't think the two are necessarily linked. I think the focus is keeping the market in balance, allowing inventories to remain, well, making sure inventories do not build. I really do believe that what happened in 2020 when inventories ballooned so much, it took them a year to bring prices and the market back in line, is something they remember very, very well. So they definitely want to avoid that. In the context of market share, I actually believe this very firmly. In the West, we look at market share quite differently. Look at what Saudi Aramco has been doing. They are going and buying refineries in Asia, buying stakes in refineries in China. That is market share. They are guaranteeing market share for the longer term. When you basically own 20, 50 or 100% of a refinery, they have to buy your crude. And I think they have been doing that as a strategy and systematically. So I don't think they're as focused on kind of quote unquote market share as we think about it. Oh, US is gaining some barrels versus, Saudi Arabia and so on. The focus, however, is on compliance. Those who haven't been complying, Iraq, Kazakhstan, for instance, Russia has been complying more now. It's more about the other 8 that are complying and have done the voluntary cuts. It shouldn't be a free rider problem that everybody else is taking advantage of them. That's where the debate is. It's not about we want to win back market share. It's about saying we don't want to be taken advantage of.
Okay, but the market has been through price wars before with OPEC Plus. Javier Blas a few weeks ago was talking about the fact that we cannot, disregard or discard the fact that that could happen. If we were to see a price war, who is going to hurt the most?
Well, I think first and foremost, let's be very clear. Even the FT article doesn't talk about anybody surging production. I know the very last paragraph mentioned it, but what OPEC Plus are talking about is the gradual incremental production coming back. Again, whether you believe the compensation cuts or not, I'll leave that to one side, but it is very gradual. Market share by definition is what happened in 2020, that everybody, surges production, like Saudi Arabia went to 12 million barrels per day, Russia was increasing production. Nobody is talking about that. So I don't think we should be using that phrase personally. If prices go down, even at current prices, a lot of countries are hurting, including the US. We actually think there's downside risk to US production next year as well. But even one of the key things that we continue to see this year, Brazil, massive underperformance. Other countries, even North Sea, massive underperformance. And by the way, the WTI strip and the Brent strip this year is still averaging above $80. Forget the price fall that we've had just now. So even $80 oil somehow doesn't seem to be high enough to actually bring production in places like Brazil. When we had $100 oil, of course, we saw that coming. So I think we need to be a little bit more realistic about the non-OPEC suppliers talking about.
Amrita, we've got to leave it there. Amrita Sen of Energy Aspects pouring some cold water over that reporting in the last 24 hours. Crude is down by more than 5% this week.
Gasoline prices in the United States, $3.22. They've been coming down significantly. So whatever it is, seems like that's the stimulus people are looking for from Saudi Arabia.
Heading south. Coming up on the programme, up next, we'll catch up with Sebastien Page of T. Rowe Price, former World Bank President David Malpass, Tom Steyer of Galvanize Climate Solutions, and Kristina Hooper of Invesco. The second hour of Bloomberg Surveillance, just around the corner.
You do have a broadening of the market.
Here's my outlook. We're going to have an incremental slowdown.
We should expect more surprises rather than things going the way that need to be perfectly done.
If you said to me, what do you think the risk of recession in the next 12 months is? 1 in 3? 30%, 35%?
A lot of the concern that's out there in the market, it's just not being priced in.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Annmarie Hordern.
Going into the opening bow with futures pulling back by 1/10% on the S&P 500. Just a little bit softer here. In the equity market, your scores look like this. On the Nasdaq 100, down by 0.25%. On the Russell, the small caps up by 0.2%. Things look snoozy right now on the week, anything but. The CSI 300 absolutely flying this week. Bramo up by close to 16%.
Can we call it a bazooka? I guess that's what we're debating. How much are they actually pledging to truly support the Chinese economy? I'm talking about the Politburo. I'm also talking about the People's Bank of China, both of them coming out. It's almost like as if the Politburo gave the message to the central bank. All right, guys, so now it's time for you to do your part. And suddenly they started cutting rates more aggressively as well.
Just sit on the equity market and think about the gains so far this week. I did this a little bit earlier. Chinese tech, Alibaba up by something like 20% on the week. Look at European luxury. Pick out LVMH up by something like 18%. The miners, Freeport, Rio, BHP, all of these names just flying. Now, I raised the question earlier this morning. We've seen movies like this before. China comes out, says the right thing, does a little bit of the right thing at the same time, stocks rip. And then they fade and they roll over because it doesn't gain traction in the real economy. Is it different this time?
Well, this is the key debate right now. You have David Tepper from Appaloosa saying yesterday, basically, I thought that what the Fed did last week would lead to China easing, and I didn't know that they were going to bring out the big guns the way they did. He's buying everything China. But then the China Beige Book's Shahzad Kazi came out, and he basically said the major takeaway from this week's announcement is the widening chasm between assets and the macro economy. He doesn't buy it because ultimately this is putting floor under some asset prices. It's not necessarily doing more than that.
But when it comes to the asset prices, if you're not bullish, you're turning bullish pretty quickly. Morgan Stanley this morning seeing another 10% upside in the CSI 300 when it comes to these Chinese stocks in the short term. I have to say, Bernard Arnault must have been looking at us coming out of China, breathing a sigh of relief. This is huge for Europe. But is it short-lived? I caught up with the French foreign minister yesterday, and they're talking about reciprocity, potentially for tit-for-tat tariffs. And they are the ones that are going to be stuck in the middle between Beijing and Washington.
How insulated is this rally from what may or may not happen on November 5th?
That ultimately is really a good question at a time, especially where there's been such a focus on Chinese policy and such a different focus depending on whether it's Kamala Harris or Donald Trump. And that, I think, is what a lot of people are looking at. At the same time, how do you trade something you don't understand? And typically, don't fight the Fed, don't fight the PBOC, don't fight the Politburo. That seems to be the theme that we feel in markets this morning.
We said earlier this week, you've got to respect the difference between what we're all anxious about and what people are excited about in the market. What we're anxious about, the prospect of a downturn in the economy, a soft jobless claims report, payrolls next Friday. What we're excited about in the market, a reacceleration of growth, an easing cycle kicking off worldwide.
Both. And ultimately, this to me, the excitement can also be paired with worry. This to me, if you want to go there, if you want to be existential, the idea that the revised data from the U.S. economy showed that the U.S. economy was actually growing more quickly than people previously thought, that the savings rate was going up. The fact that you're not necessarily seeing the slowdown in certain aspects of the economy that people were counting on for inflation to keep coming down. Are we truly in a disinflationary nirvana, or is this something different that is a new regime? And ultimately, we don't have a finger on exactly where we are now, let alone where we're going.
We'll try and answer some of those questions this hour. Coming up on the programme, we'll catch up with Sebastien Page of T. Rowe Price on why he's optimistic on the economy. We'll speak to former World Bank President David Malpass on a more protectionist Washington, and Kristina Hooper of Invesco on this week's massive rally out of China. We begin this hour with stocks close to all-time highs after posting the 42nd record of the year so far. Sebastien Page of T. Rowe Price looking for the rally to broaden. We're positioned for the market to broaden over the next 6 to 18 months. We're prepared to add to risk assets incrementally should stocks pull back over the next few months. Sebastien Page joins us now for more. Seb, it's good to see you. Welcome to the programme.
Great to see you. Thank you.
If you're waking up this week to some of this price action and you're wondering, Is my home bias a little bit too large? Do I need to look abroad and get out of America? What's the advice you're giving people?
I think you should consider broadening your exposure globally. We're roughly neutral between international and U.S. stocks. You know, we talk about high valuation. I think, Lisa, you just hit the nail on the head with excitement coupled with worries. But if you look at valuations in the U.S., get 21 price-earnings ratio for the S&P 500, the average stock in the world is trading at 13, 14 price-earnings ratio on the forward earnings. That's actually the long-term average. So there's an opportunity to broaden international exposures.
Let's talk about where. You've got miners listed in London, luxury players listed in France. You've got the tech names that you can pick up here in the United States and over in China as well. Where do you want to be?
So we're actually long emerging markets. We like Japan, Europe a little bit less. I know you've been talking a lot about Germany and struggles there and how that's linked to China. And by the way, on China, it does look like a meaningful stimulus. But our analysts are writing research right now on our research platform, and they're saying, look, this is a short-term boost to confidence, but it's a different context. China is just structurally challenged for investing with youth unemployment at 18%, with foreign direct investment having completely cratered, with a really difficult property market. Like, that doesn't change on a dime.
That said, the feeling that you're on this global easing cycle where even China's on board, and they're actually even injecting fiscal, and they're promising more, and they're getting people excited that maybe they're focusing more on the economy, just adds to this feeling that we're in a new regime once again, that there has been a seismic shift that now makes it really kind of, I don't know, for some people almost inexcusable not to go into risk, because basically central bankers are saying, please, by all means, we'll pave your path. Are you getting more than just simply aggressively neutral?
Yeah, look, add China to the case for the bulls. I said last time I was on, we're having massive debates in our asset allocation committee right now between the bulls and the bears. And someone told me I was being too long-winded, so I tried to make the bull case in 4 words. Can you make the bull case in 4 words, Jonathan? Basically, the bull case to me, in the simplest way possible.
Central banks are cutting.
That's a good one. But try, rates down, earnings up. That's a very pragmatic bull case. The bear case, of course, to your point, excitement coupled with worry, is that the economy, the Citi economic surprises are negative for 5 months in a row. So economy down, valuations way up. I guess that was an extra word, way up. But so we are slightly overweight stocks. We want to add over the volatility that we expect during the fall, incrementally. And I think it's good to talk about adding in the future now, because those decisions are hard to make in the moment. When stocks are down, it's just harder to buy, but we tend to do that, so we're preparing the groundwork for that.
This market doesn't agree with itself. It seems like there's a feeling of mispricing, because on one hand, earnings up, growth, everything's going great. Does it make sense for the rally to also be in the long end of the yield curve at the very same time that people are talking about a reacceleration in growth?
Yeah, look, even the probability of recession right now is a huge debate. I mean, if you look at things like manufacturing PMI, the yield curve, which we talk about a lot, and the rise in unemployment, 40 basis points over the last 12 months, I can show you statistically that based on these 3 scary bearish indicators, the historical probability of recession is 92%. So that's scary. But if I add any kind of market pricing, stock returns or spreads, and the level of unemployment, which, by the way, unemployment is low by historical standards. Like the historical average is 5.5, 5.7. That's the historical average. If I add those 2 variables, run the same model, I go down to a probability of recession of 11%. And so you see this, like, depending on whether you're looking at green cells on your macro dashboard or red cells. And it's a little bit of a knife's edge right now. And that's why you're talking so much about claims and how they're going to matter over the next couple of weeks.
Is that what matters the most to you right now in this market? That kind of data?
Yeah, I think the employment data is really important. It is lagging in predicting recessions. Claims aren't as lagging as the rest of the data set. But ultimately, when you invest in stocks and think about your weight in stocks versus bonds, earnings really matter as well. And if you go back to my 4-word bull case, rates down, earnings up, that is a big part of why we're looking to add over the next few months.
What's the forward bear case to the individuals on your investment committee that are saying, hold on, we need to press pause?
We tend to be contrarian. 21 price earnings ratio on the S&P 500. The S&P is up 60% over the last 2 years. We don't like to buy stocks when they're that high. We're fully invested. Things are looking good. But this is not time for massive overweight.
Jobs crash, valuations high. I think that you could say that would be the forward.
Lisa's good at this game.
You could basically say that, right? Ultimately, what you're looking at, how much do you really understand the data that we're looking at as being accurate, given some of the backward revisions? I really was struck by yesterday's backward-looking revisions of GDP, showing it was substantially higher when we look at the 3 years following the pandemic. And you look at the savings rate, that was 2 percentage points above the previous estimate. This basically shows that consumers have a lot more money in their coffers, and maybe they haven't spent their savings. How reliable is the data that we're hinged on every week in this data dependency?
The data seems much less reliable than it used to be. It's the COVID normalization. I'm not an economist, but I look at all these revisions and I start doubting the survey methods, the measurement methods. But, it's just not that bad in the employment. However you want to look at it, it's trending in the wrong direction, but the levels of employment in this economy are still pretty good. And claims in the 200s, this is a robust economy.
I want to talk about the election and finish there. This note just dropped from Michael Purvis of Toolbacken. The real election risk is in December. The real election risk is not a blue or red sweep, but a narrow win by Harris, a win which becomes contested by Trump. How are you and the team thinking about the election?
Well, contested election would be a problem and disappointing. I think most investors on our platform would say that a divided outcome is probably most favorable for markets. I mean, this spread between potentially 15% corporate tax rate to 28% corporate tax rate, these outcomes could matter and they could generate volatility or massive tariffs, right? So we're going into an election where we should see market volatility. I know that's a bit trite to say, market volatility. We always have market volatility. But I think the divided outcome is the safest for market where you don't get any extreme policy shift.
It might be the safest for the markets, but what's your base case? Is gridlock your base case?
Yeah, I think so. And it speaks to the deficit, which I think we're kind of kicking the can down the road. I know it's a topic on Bloomberg Surveillance. We're running massive, recession-like deficits, 6% of GDP. And that will work, and you have fiscal stimulus in the system, which on its face is a good thing, but you're kicking the can down the road. And I know a lot of your guests talk about that, but it is going to be a long-term problem. But so, in that context, I think we're okay, but you really need to watch the auctions.
Thank you. I appreciate that.
You've got a friend in Lisa, that's for sure. Sebastien, thank you, sir. Sebastien Page at T. Rowe Price, appreciate it. Equity futures on the S&P, we're down 1/10%. Let's give you an update on news elsewhere with a Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. UK Prime Minister Keir Starmer dined with Donald Trump for 2 hours last night. The two men discussed the long-standing friendship between their two nations and the importance of maintaining an enduring partnership. That's according to Starmer's office. While the British Premier had hoped to also meet with Kamala Harris on the visit, reporters traveling with him to New York were told that diary challenges prevented it. Meanwhile, shares of Moncler are rising in Milan, up 5% after LVMH said it was investing in the designer outerwear brand. As part of the deal, LVMH is buying a 10% stake in Double R, the investment vehicle controlled by Moncler CEO Remo Ruffini. LVMH will also get a seat on the Italian company's board. Moncler, which sells down jackets that can cost more than $6,000, has more than quadrupled its sales over the past decade to about $3.3 billion. Meanwhile, Peter Thiel is cashing in on Palantir. According to regulatory filings, the billionaire has sold almost $600 million of stock just this week. Thiel, who was a co-founder of Palantir, has now sold more than $1 billion of his stake this year. The filings do not disclose a reason for the sales, and Thiel has not responded to Bloomberg's request for comment. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, we'll catch up with the former World Bank President, David Malpass. That conversation just around the corner. Equity futures negative 0.1% from New York this morning. Good morning. Counting you down to the opening bell with equity futures down 0.1% on the S&P 500. Your scores shaping up as follows. Big rally over in China again overnight, in Europe as well. Not much follow through stateside, and the bond market yields down a single basis point, 378.48. We've asked this question a few times already this morning. Easing in America, easing in China, the prospect of more rate cuts from the ECB. Should yields be higher and not lower off the back of the news of the past week?
If you believe that inflation is still a present threat, then arguably, why wouldn't they be higher? It seems like this market has gotten comfortable with the idea that disinflation is here to stay and that it can continue regardless of what happens with rate cuts and stimulus coming out of China.
Big conversation about policy over China. Joining us now to discuss is the former World Bank President, David Malpass. David, good morning. It's good to see you, as always.
Good morning, everybody.
Has the spread between sound economic policy and the kind of campaign promises that get you elected, has it ever been wider?
Well, there's a huge fight over what we should do and which way we should go. So that's a wide divide. From the market standpoint, I think they take it with a grain of salt and say, we're going to figure out a way to get through this. So bottom line comes out to earnings. You know, we know that old game. How do you make money within a volatile environment? And I think the markets are showing they're able to do that. Plus, they've got the Fed put behind them. We have to realize what's going on as markets get dicey. The Fed steps in, and so that changes really the value of everything and addresses what Lisa's talking about on the bond yield.
Before we get to the economic backdrop, I just want to spend a bit of time talking about specific policies. Can we talk about Nippon Steel? Nippon Steel, to us, is a great example of where we are right now in this country. It feels like there's a big divide between doing the right thing and doing the kind of thing that gets you elected. Nippon Steel, we're talking about a Japanese ally looking to take over a US company. And no one on the campaign trail wants to entertain it because they know if they do, they won't win the election in November. How problematic is that? Because that doesn't feel isolated. That feels like policy across the country.
Yeah, and it's a a change in the U.S. direction of inviting foreign investment into the U.S., but it's the Biden administration really pushing that. I've been disappointed in that. They're the ones with the hand on the steering wheel right now and moving away from inviting foreign investment. But let me change gears. There's a giant problem in the world with the playing field not being level. And so this is going to be a fight that goes into future years, and it's both parties trying to figure out where the U.S. wants to be in that fight. So I think there's got to be a lot of work done on what do we want in terms of foreign investment into the U.S. and into certain sectors and industries.
But David, when it comes to Nippon Steel, the Biden administration is taking this approach because they were pushed there. And they were pushed there by Trump, who in January of this year said, I would block that deal. Then Biden-Harris had to come out and basically get behind Trump because it's an election year. Don't you think that the former president is also an individual that, if given this choice, would block that decision?
He's got views, and he's a leader, and so what you're basically saying is Biden is following the leader, and Vice President Harris is following the leader. That's not a good position for the U.S. to be in if it's trying to lead in the world. That's one of the problems going on in the world is the vacuum of leadership from the U.S., and the world is really having to look at that in each of the forum. What are we going to do when the U.S. is not really showing where it's going to go?
I'd love to also get your thoughts on one policy proposal Trump continuously talks about. So Republicans, when Kamala Harris came out, was talking about price gouging across the board for groceries. The Republicans were all saying she's a communist, this is price controls. What's the difference between that and capping interest rates on credit cards, which was a Bernie Sanders policy proposal? Now Trump's saying they should do it too.
I'm not in favor of all of those, but price controls, you know, as described by VP Harris, were sweeping, and that's just not a good answer to what you're going to do about inflation. You've got to have some answer that talks about more production, and that's what President Trump did. I think that's the better approach. If VP Harris is asked about inflation the next time, I hope she doesn't talk about the middle class, and maybe she can just say, look, I'm going to try to have our economy, the private sector of the United States, produce a lot more. That's the way to deal with inflation. And she's just not saying that. She's got the government pushed into the middle of every part of the U.S. markets.
You said that the U.S. needs leadership and clear leadership in terms of what its positions are in certain places. I'm just wondering, do you have a clear sense of how to weigh national security versus letting fair and free trade and business, what that looks like under Trump?
I don't know under Trump. I know that issue. So starting in the 1980s, there was a big push and discussion of what was industrial policy, how far did you want to go. There was the beginnings of CFIUS, the Committee on Foreign Investment in the United States. I was at the Treasury Department at the time and substantially involved in that. And there was lots of discussion of what is our national security, and within the U.S. government, how do we balance the various interests. So the Treasury Department is the chair of the CFIUS, and that keeps a balance between the Commerce Department, which wants to export and wants to tended to, and the Defense Department, which often wanted to block. And so that kind of debate has been with us for a long time. It needs to be really worked out among leaders within the U.S. As the decisions come down. In the 1980s, it was Fairchild Semiconductor. It was France's investment in the U.S. and Japan's investment in the U.S. that were really causing political tensions in the U.S. So it's not such a new thing now. It's just got to be discussed really from the standpoint of what's our national interest.
There's also a sense of knowing who our friends are. What does friendshoring mean when we try to change up our supply chain? Yeah. Donald Trump recently said that if Deere leaves the U.S. and moves some of its production to Mexico, he said, I'm just notifying John Deere right now. If you do that, we're putting a 200% tariff on everything that you want to sell into the United States. Do you have a clear sense of who our friends are under Donald Trump versus under Kamala Harris?
Well, we know that to Trump, it's going to be American workers. And he's going to use more tools and tools more strongly stated than what the Biden-Harris administration has been doing. So that's the big challenge of how do you really enter a world negotiation where the trading system is broken, the foreign investment system is really broken in part because China is not following the rules and is, the intellectual property problem is still with us, and so we see in each of these areas there's got to be a balancing. I'm back to the same thing of what's the national interest and how do we do the best job for workers in the U.S.
But what Lisa's talking about is Mexico. So is Trump basically trying to ditch the USMCA that he negotiated under his first term? No. What he negotiated was a very strong agreement. It's not being fully implemented, and Mexico has walked away from some of the principles of that. So as you look at it, these are living, breathing documents. You get the best negotiation you can. That was 2018, and then you try to get Mexico to stay on course. But think how much has changed in Mexico in these last 6 years of a government that really was anti-business, was the first act of AMLO, the current or just departed Mexican president, López Obrador, was to stop the airport that was being constructed. They needed that airport because of the expansion going on in Mexico. But he said, I don't like those contracts, and just ended it. So we've got a partner to the south within the USMCA that's got major problems. So there has to be real discussion in the U.S. of how do we interact with Mexico when they've been leaning toward China.
It's a big to-do list. David Malpass, we've got a lot to talk about. Hopefully we talk before the election once again in the next month or so. Thank you, sir.
Good to see everybody.
Good to see you, sir. David Malpass there, the former World Bank president. Up next on the programme, Tom Steyer of Galvanize Climate Solutions. That conversation just around the corner. Equity futures on the S&P 500, negative here by 0.1%. This is Bloomberg. Two hours away from the opening bell, just around the corner with equity futures down 0.1% following the 42nd Record high close on the S&P 500 of the year so far. We're down about 0.1% on the Nasdaq. On the Russell, we're up by 1/3. Over in Europe, the rally continues. Across Paris, France, into Italy, into Germany. The CAC 40 up by around about 1/3%. The DAX in Frankfurt, Germany, up by 0.8. In the bond market, put it all together. Your 2-year, 10-year, 30-year yield looks a little something like this. Yields are lower by almost a basis point on a 10-year, Lisa, 378.67. Yields have been pretty stable through the week.
If you missed it, welcome to soft landing nirvana. That seems to be where we're at, with the whole world seeming to cut rates and everybody basically saying it's now time to buy risk. It really feels like this week is broken down into 3 questions. How far are policy officials willing to go? How much does this affect the real economy? And just how strong or weak is the economy currently? It seems like all of those answers so far have been pretty far, maybe significantly, and actually pretty strong.
Should the easing out of China lead to high yields in America? We've had that debate through this morning so far. It's certainly leading to higher equities over in China. The CSI 300 on an 8-day winning streak, the longest since February of this year, and on the week up by close to 16%. There's one market that's not rallying right now, and it's down in a big way. Nikkei futures over in Japan, negative and down hard. We're off by more than 4 full percentage points. The Japanese yen is a whole lot stronger. Lisa, dollar yen 143.14.
For the first time in a long time, Japanese stocks aren't on sale in the same way that they had been to foreign investors. So maybe people are getting a sense that, yes, maybe this Bank of Japan is truly going to hike rates more significantly, because they did pick a new leader who is actually open to that kind of normalizing cycle. Again, this sort of shows how much Japan dances to their own music. They currently are continuing to do so. Maybe the last time that you could really go to Japan cheaply was this summer. And if you missed that, I'm sorry, because I heard that the sushi was very good.
Your family did not miss out on that. You timed it perfectly,
a member
didn't you? 160,
of my family,
dollar
yes.
yen.
I actually managed to transform some currency at that very peak.
Abramo, leading foreign exchange worldwide. Under surveillance this morning, Donald Trump saying he plans to meet with Ukrainian President Volodymyr Zelensky after criticizing him in recent days. Trump saying that if elected, he will force Zelensky to be the bargaining table with Russian President Vladimir Putin. It's been a difficult week for the Ukrainian leader.
It will. It has been. And you see what the Wall Street Journal editorial board framed it as this morning. Whoever's giving Volodymyr Zelensky advice on American politics is doing Ukraine no favors. We've seen a real change in tone from Volodymyr Zelensky. I sat down with him in July. The sense I got was he wanted to speak to Donald Trump. He wanted to hear what the plans were. He was setting himself up for potentially the polls we were all watching, which is showing that this election is on a knife's edge. Yet he comes here and he says very different things to the New Yorker about the former president, very different things to New Yorker about his running mate, and also decides to go to a swing state of Pennsylvania. And it's not just the Trump campaign that he's unnerving. I spoke to someone in Congress yesterday. The concern is that he will push more Republicans against Ukraine. And whether or not it's Trump or Harris, they need congressional support for some of the aid that they're going to be asking for.
Speaker Johnson calling for the firing of the Ukrainian ambassador this week. I know there's been a lot of news and it's kind of been buried and slipped under the radar, but that's real news.
Especially at a time where there's a real question of whether or not a Republican-led Congress and a Republican-led government would actually continue to support. I find this interesting that it's coming on a world stage in New York City at a time when the UN General Assembly is here. How much is that sort of emboldening a lot of rhetoric that we're hearing on all sides? And oh yeah, by the way, New York City isn't in such great shape either, as we keep learning.
Let's get to that news. New York City Mayor Eric Adams is set to appear in federal court this morning, where he's expected to plead not guilty to charges including bribery, fraud, and accepting illegal campaign contributions. Adams saying he will continue to serve as mayor and will defend himself against the charges.
Innocent until proven guilty. That is what everyone said, except not really when you look at other Democratic representatives who keep coming out and calling for him to resign. Key question, given how many people have been roped into this investigation throughout the administration, throughout the departments in New York City, the fact that this has gone on for months and months raises the question, how long can this government continue to operate? The U.S.'s biggest city at a time when there are some real questions swirling. And what is Governor Hochul going to do about that?
You made a good point earlier. It looks like Governor Hochul was watching former Speaker of the House Nancy Pelosi and how she thread that needle with President Biden. Her statement, quote, "It's now up to Mayor Adams to show the city that he is able to lead in that manner." Putting in his camp, but clearly there's a bias of, look, you don't have the public behind you. It's time to step aside.
Do you remember that line? We're waiting for the president to make a decision. He'll make a decision.
I actually thought it was very much taking a page out of that book, basically saying, we're waiting for him to make the appropriate decision. Do what's appropriate.
The right decision.
Right. So make the decision. You made the decision. You're going to stay. Try making it again.
Watch this space. When we get the news on this one, we'll share it with you. Let's get to this story. An East Coast port. The strike there starting Tuesday, and it's becoming increasingly likely. Talks between the International Longshoremen's Association and terminal operators have been at a standstill since June. The White House saying it won't step in. We're getting closer and closer to that strike happening.
To me, this is one of the most underplayed stories I could possibly imagine. If they go on strike, it's going to cost the U.S. about $7 billion or more than that a week in terms of lost economic output. You're talking about one of the biggest ports with all sorts of goods, could potentially lead to inflationary types of supply chain disruptions right before an election. So really a fascinating moment that somehow isn't getting as much attention as many people I would think would want to be focused on.
It would be the first time since 1977 it's not getting enough attention, except for when I talk to people in Washington, in the administration, this is one of their biggest risks and wild cards before the election. One issue, inflation. This is a resurgence of inflation. This does not bode well for Biden-Harris. Second, she doesn't want inflation, but does she come out then and support the unions? This is going to be really politically difficult to walk that line.
This is one on our radar for next week, that's for sure. It's been a big week here in New York City. Kamala Harris and Donald Trump have been getting back on the campaign trail as well. The Trump campaign pledging to increase energy production to spur U.S. investment and manufacturing, and the Harris campaign pledging to create a national stockpile of critical minerals in order to reduce U.S. reliance on China. We're lucky this morning. Joining us around the table is Tom Steyer of Galvanize Climate Solutions. Tom, it's good to see you, sir. Welcome back.
Good morning.
It's been a fantastic week of conversations, many of them energy and climate related. I know you've had similar conversations this week. Are you walking away from these meetings this week more optimistic, more constructive about the future?
Well, I came in pretty optimistic about the future, and I'm leaving even more optimistic. I think we're in the middle of a new industrial revolution. I think that the energy transition has a lot of momentum, so I feel very good about where we're going from a business standpoint.
What's encouraging you the most right now? What are you hearing that's giving you the most encouragement?
Well, I think the big thing that's happened is that clean energy and the new technologies are winning in the marketplace, and they're winning in the marketplace around the world. So we can talk, I think most people think that at some point we're going to start going through an energy transition, but the actual truth is we're right in the middle of a very fast energy transition around the world, and really nothing's going to stop it.
We're also in the middle of an election cycle. Are you disappointed that Kamala Harris in her 82-page economic policy document was actually touting U.S. record fossil fuel production?
I really think that the Harris-Walz campaign is trying to talk about energy and meet voters where they are, which is about economics. We know that Kamala Harris has been a strong advocate of clean energy for decades. We know that Governor Walz has a very strong climate record. But when they're talking to voters on the campaign trail, it's not about what you want to talk about, it's what they are able to hear. And what everybody in the United States is worried about right now is economics, is about us succeeding, is about jobs and costs, and that's what they're talking about. And I think that's entirely appropriate.
If that is accurate, which I think you do, everyone is talking about this, then why put the brakes on some projects that could fuel all of this? We spoke to the Rio Tinto CEO yesterday, who basically said it was the Biden administration who put a pause on a mega copper mine in Arizona. Part of this has to do with politics.
I know that there's a lot of talk about critical minerals, and I know that people are pointing out different ways that this revolution can be slowed or you can lose its momentum. And I believe all of those conversations are overblown. I believe that, in fact, what we're going through is a huge business transformation, that it has amazing momentum. Will there be problems with it about permitting and the grid and critical minerals? Absolutely, and people talk about them all the time.
Sure.
But they're missing the big picture, which is, if you look at 2023, globally, 83% of new electricity generation was renewable. Was anybody doing that to be nice? Nobody. They did it because it's a better deal. You know, we're really in the time of cheaper, faster, better. In fact, the new technologies are better and they're cheaper, and people around the world are adopting them for that reason. Not to be nice, not to save the world, because it's a better deal for them.
Just to pick up on that chart of crude production, north of 13 million barrels a day in America, we're certainly less reliant on OPEC. We've had some guests on the program this week making the suggestion that we're becoming more reliant on China for some of those critical minerals. I want to pick up on Annmarie's point because I think it's important. The Rio Tinto CEO was talking about Resolution Copper. It's a copper deposit that could meet 25% of American demand year after year for years. I want to understand from your perspective, do you believe that US authorities have actually had a sufficient reality check to understand where we need to get this stuff from and what we need to start doing now to make sure we can meet that demand a decade out?
Look, there's no question that a lot of minerals are dispersed around the world and in countries that aren't necessarily as stable as ours is. But let's take a step back on that one, because the alternative in what we're talking about is fossil fuels. And if you look at the world stage and how many of the wars over the last 50 years have at their heart been about fossil fuels, have been in fossil fuel countries, how many of the wars that we're going through right now are led by people who are in oil-rich countries? I think it's really clear that moving to renewable energy, which is dispersed around the world where people can get it in their own countries and use it in their own countries, is something that will dramatically drive down the conflict in the world and make us much more secure.
Just to build on what John was talking about, we're in the middle of an energy transition that hinges on products from China. Basically, solar panels mostly come from China. A lot of the products that go into batteries of electric vehicles also from China. Is that the path forward?
It doesn't have to be. I mean, there's a real question here, and I believe this is one of the big questions for the United States in this campaign, and it's a big partisan divide in the United States, and I regret to say it. China doesn't have any oil and gas. They are all in on the energy transition. They are electrifying 10 times faster than the rest of the world. If you talk about the new energy movement, half of it is in China for the whole world. The United States, we're the biggest oil and gas producers. We have a huge people who are pushing to stay the same, to move backwards, to rely more on fossil fuels. Let me give you an analogy. Electric cars. The first people to develop an electric car in the United States was GM. GM makes a lot of money selling SUVs. They looked and said, electric car, we lose money on every one, we're not going there. Tesla, who has no internal combustion engine capability, went all in on electric cars. They were the upstart. That's kind of where we are with China. China's all in, and we have people who are asking us to tap the brakes, slow down, let's stay with the 1950s. Absolutely we can win this competition, and absolutely we have to be in this competition. But if we decide that the future is fossil fuels, then we will basically draw a moat around ourselves and not compete in the critical industrial revolution, and that is terrible for us, because this is absolutely where the world is going. We absolutely can compete and win in this, and if we choose not to, that's a terrible outcome for the United States of America.
You made an analogy about this week as being like a shoe convention for shoe manufacturers for people in green energy space. How many people who came to this shoe convention or energy convention were big tech executives?
A lot. You know, look, I live in California. The center of the tech industry in the United States is in California. And in general, as we look at the scaling up of AI and data centers in the United States and around the world, one of the key elements to how fast that can happen, and for every one of those companies that wants to lead in AI, is the ability to get energy. And so they're all over this, and they are focused on doing it, and they have high expectations about clean energy and being good corporate citizens, but they are, people think Californians are laid-back surfers who smoke a lot of dope. Let me say, serious business people who are competitive.
Some of that
as
going
heck.
on too. There's a bit of that going on as well.
Life is about balance, Tom. When it comes to Lisa's point about these AI data centers, what we saw from Microsoft with 3 Mile, who is better at this, the tech companies in the private sector or the U.S. government?
Well, it's interesting because let's just take an example. One of the things that is changing, people are looking at a lot of new technologies for generating clean electricity. And one of them is enhanced geothermal. Okay, enhanced geothermal is basic. Geothermal is the equivalent of Old Faithful, hot water and steam from the earth. And Traditionally, it's been done very close to the surface, within 500 feet. And that's why Old Faithful, it's so close that people can go and it's always spouting. Enhanced geothermal is going down 10 times deeper, using oil and gas technology, oil and gas rigs, oil and gas workers to get the same thing, but in much bigger size. So the question is, okay, did the US government make that happen? Did the private sector make that happen? Did the tech companies make that happen? And the answer is yes.
To put a bow on that, how much are big tech companies looking to buy directly energy assets to own them, to be owners and funders of these types of projects and infrastructure?
I think they're doing something different. I think what they're trying to be is direct buyers from the producers of clean electricity. What you saw at 3 Mile Island, it wasn't that Microsoft wants to own energy assets. It wants to have a direct contract and be the offtake so that they can develop energy assets. And that's the role they're trying to play. And I think that's a super constructive role. And I think that by and large, they're doing a very good job.
Tom, this was a smart conversation and we always appreciate your time, sir. It's good to see you again.
Great to see you guys.
Thank you. Tom Steyer there of Galvanize Climate Solutions. So let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. Apple is rolling back ambitious plans to bring its movies to the silver screen. Its latest movie, Wolves, is set for release today on its streaming platform Apple TV Plus after canceling plans to release it at thousands of theaters globally. The tech giant originally planned to shell out $1 billion annually on films for cinemas, but several disappointing box office performances have forced the company to shift gears. Apple has declined to comment on the move. Meanwhile, DirecTV and Dish are close to a merger agreement. According to people familiar, the companies are in advanced talks for a deal that would create the largest U.S. pay TV provider with almost 20 million subscribers. An agreement could be announced as soon as the coming days. DirecTV is in talks to control the combined entity, according to sources. And the MLB postseason picture is coming into clearer focus as the Yankees and Dodgers clinched their respective division titles last night. For Los Angeles, it's their 11th NL West title in 12 seasons, with their only World Series win in that time coming in the shortened 2020 season due to COVID. 4 playoff spots remain coming into the final weekend of the regular season, with the Mets looking to clinch a wild card berth before a potentially season-defining doubleheader against the Braves on Monday. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira again in about 30 minutes. Up next on the program, a massive week in China.
It's very powerful. It's a very exceptional time where PBOC actually encourage the financial institution, including banks, to get exposure, get leverage in the equity market.
That conversation up next. The View from Invesco, just around the corner. This is Bloomberg. Equities on the S&P 500, negative by 0.03%. That's a conversation for another day. In the bond market, yields are lower by a single basis point on a 10-year 378.29. Under surveillance this morning, just a massive week in China.
What we got in this market this week is partly because expectation was extremely low, right? Position were low, valuation were low, and they came up with a big positive surprise. We need to see expectation versus what they deliver. But I want to emphasize, even on the monetary policy side, it's very powerful. It's a very exceptional time where PBOC actually encourage the financial institution, including banks, to get exposure, get leverage in the equity market.
So here's the latest. Chinese equities notching their best week since 2008. Total gains on a CSI 300 coming close to 16%. Single names like Alibaba, JD.com, Baidu all gaining close to 20%. The rally coming on the back of a long-awaited stimulus coming out of the Chinese government. Joining us now is Kristina Hooper of Invesco. Kristina, it's good to see you. Welcome to the program.
It's great to see you too.
Is this the real deal, a game changer in China this week?
I think it could very well be. I mean, certainly the initial reaction suggests that it could be, that it's certainly more than was expected, and seems like there's a real commitment to follow up with more as needed.
Talk to me about what changes for you, because a lot of people are waking up thinking, I've been overweight US relative to the rest of the world for a long, long time. Does that need to change?
I do think it needs to change somewhat, but I would say where the bigger overweight is still cash. And so there's an opportunity to deploy and get one's portfolio more into balance, but not necessarily take away from U.S. equities, but just build up exposures to other areas like European equities, like Chinese equities instead. And I think there's a real argument to move more into China because valuations are very attractive. We've just been waiting for that catalyst. It seems to have arrived.
I love this. People, person after person who comes on the show, get out of cash. Why are you in cash? There's so many other things to invest in. Lock in these yields. Go to China. Go to equities in the U.S. Go to Europe. And what did we see over the past week? The biggest weekly flow into cash funds, into money market funds, going back to March of 2023. How do you understand that?
Well, I think there's certainly a lot of nervousness out there. There is an excitement about rate cuts and the opportunities that they bring, but there's also this trepidation that what if that 50 basis point cut was a crisis cut? What if the economy is on worse footing than we think? And let's face it, what if other areas of the world are on worse footing than we think? So I think there is certainly a bit of a split personality for markets right now, where there are those that are hedging their bets. Look at the kind of money that's going into gold as well. But at the same time, there's an excitement about equities, and I think that is rightly placed because I do believe my base case scenario is the U.S. does see a soft landing and that we see a pretty brief soft landing with an economic reacceleration to follow.
There's a real question here about whether that soft landing can come with a rally in everything. The sort of soft landing nirvana that supports bonds as much as it does stocks, as much as it does this broadening out trade.
Well, I think of it as almost the opposite of 2022, where virtually everything sank. And so you can have a year where you have an everything rally. You can have an everything bagel. Why can't you have an everything rally?
I love that. Everything bagel on an everything rally. Well, potentially, and your notes put it, the markets are still swimming in a sea of uncertainty. Out of all those uncertainties, what ranks number one for you?
Whether or not the U.S. has a soft landing. Let's face it, we're certainly getting data that tells us that the economy is in fairly good shape. But there is that fear that because of the long and variable lags of monetary policy, that aggressive tightening cycle, that restrictive monetary policy environment catches up with us. And so that's why I think we follow consumer sentiment so closely. And that's why we had in reaction to the Conference Board consumer numbers the other day. But I would argue when you actually delve into the information, what you saw was consumers got much more negative on the economy, but they still want to spend, they still want to go out to eat, they still want to go to the movies. So I think of it more as an Eeyore economy, where consumers are worried, but they're not necessarily acting on their worries.
It's America. We catch up with the Conference Board a little bit later. Isn't that America? We're still spending. Anxious, but still spending.
Well, you know, to me, this is the sort of big billion-dollar question. Everyone's been saying, you're running out of savings. Americans just go and they're reckless, ruthless. They spend anyway. They're going to borrow to spend. But actually, the savings rate, it was substantially higher than we previously reported in new data. So maybe people actually haven't been imprudent. Maybe Americans were smartly spending on things that mattered to them and trips and, you know, kids.
They also have credit cards. So even if you're worried about losing your job, you might as well YOLO, go out to dinner, go to the movies, go on a vacation, have some fun.
And Donald Trump's going to cap the interest rate on the credit cards, right?
Potentially.
What did you make of that? Can I just pick up on that? I think it's really important. We've talked a lot about price controls coming out of the Harris campaign. We haven't talked enough about this. Capping interest rates on credit cards. Can you imagine what would happen if we did that? We'd basically only have credit allowed for people who had high FICO scores. And I mean really, really high credit scores. There'd be a lot of people locked out of credit markets.
Two things. One, again, is Donald Trump a Bernie Sanders bro? Like literally a Bernie bro? Because this is what the progressives have been talking about, but at a 15% cap, AOC and Bernie Sanders. But what was interesting is what we heard from Mr. Malpass was a serious, immediate step back. I'm not one of those people. He doesn't really think that that should be happening.
All I can say is think about all the money in private markets that would come up with creative ways to give credit in other more punitive rates later in some other views. So I mean, it's not that they'd be locked out. It's just, you know, you really want to borrow? Come on over here.
Yeah,
I've got a price for you.
Don't underestimate innovation in financial markets in America. Kristina, it's good to see you. Thanks for being here. Kristina Hooper there of Invesco. In the next hour on this program, we'll speak to Eric Freedman of US Bank Asset Management. We'll catch up with Stephen Trent of Citi, Dana Peterson of the Conference Board. Look out for that. Consumer confidence from them this week, making a lot of headlines. And then we'll catch up with Michael Contopoulos of Richard Bernstein Advisors. Payrolls is a week away. We'll give you a sneak peek of our survey on the other side. Equity futures just about unchanged on the S&P 500 after closing at all-time highs in yesterday's session for the 42nd time this year. In the bond market, yields are lower by a single basis point. Your 10-year 3.78. And over in China, another rip-roaring rally in Shanghai. From New York, this is Bloomberg.
We do feel like we're getting closer to reaching an inflection point, but it's not clear which way the economy is going to break.
Consumerism is very strong right now. We think the consumer is actually really well set up here.
What won't likely validate the Fed's 50 basis point cut will be how good the consumer continues to do.
The consumer is moderating. It's not a terrible thing. This is what we were hoping for.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
90 minutes away from the opening bell. Let's check out the scores. They look like this. We're unchanged on the S&P 500. On the Nasdaq 100, just about unchanged as well. On the Russell, the small caps were positive by a third of 1%. Muted price action this morning. Anything but through the week. Heading towards a third week of gains on the S&P 500. And a run continues out of China. The CSI 300 on an 8-day winning streak on the week, up by close to 16%. This time next week, we won't be talking about China. We'll be talking about the payrolls report. It is just around the corner, a week away today. The estimate, 130K. That's the median. The previous number, 142. The low. Let's talk about the low. 70,000 out of Citi. Andrew Honhorst looking for 70K on payrolls next Friday.
Which potentially could be revised into contractionary territory after we get the post-facto data. A key question here is, how much does this really ignite the Fed's response mechanism with bigger cuts? And how much is this viewed as no longer such a positive for markets, given the fact that ultimately everyone is saying now we just need to see the soft landing come to fruition?
This is why I'm excited to talk to Dana Peterson of the conference survey, because when you looked at the data, it does look like people are starting to really have a lot of this nervousness about the job market. Are they plentiful? Not really. Are they harder to find? Yeah, they are.
Do you worry about the what or the why? What they're doing or why they're doing it? What they're doing, they're easy. They're cutting rates at the Federal Reserve. They're doing stimulus over in China. The why? Got a deflationary spiral over in China. Got a slowdown potentially in the United States. If you're in the market right now, we've talked about this a few times, are you excited about what they're doing or worried about why they're doing it?
Ostensibly, in China, you've been worried about the why for so long that now the what they're doing is actually really significant. So China's sort of a separate story. In the United States, the why is sort of a question mark right now. Are they doing it because things are actually weakening, or are they doing it to get ahead of potential weakening? Lisa Cook, Fed governor, yesterday, and some of the Fed speak we heard yesterday, said that she wholeheartedly supported a half percent rate cut, saying that decision reflected growing confidence that with an appropriate recalibration of our policy stance, the solid labor market can be maintained in a context of moderate economic growth. That's the kind of backdrop, the why.
But based off what's going on in China, if this stimulus package actually helps and you do inflation start to pick up in China, no more of a deflationary trend, how much does that unnerve and hurt the Fed as they are trying to cut interest rates?
Which introduces gold perfectly, a series of all-time highs on a week so far, Bramo.
Okay, so how much is this people hunkering down for inflation? How much is this fear of, some sort of Armageddon because people just, stockpile gold? How much is this foreign buying? Everyone, when I bring it up, I've gotten some eyebrows raised. Some people say, really, Lisa, gold? But it is notable in terms of an inflation hedge that people are going there instead of going into bonds amid this global easing cycle. And that, I think, is something that we have to keep watching.
Let's get to the lineup this hour. Coming up on the program, we'll catch up with Eric Freedman of US Bank Asset Management as the S&P 500 notches its 42nd record high this year. Stephen Trent of Citi as Southwest shares surge on a buyback plan and new passenger policies. And Dana Peterson of the Conference Board on inflation in America. We begin this hour with stocks hovering close to all-time highs after posting the 42nd record close of the year so far. Eric Freedman of US Bank Asset Management saying this: we have a glass half full, positive disposition towards risk assets based on a still robust profit cycle and companies focused on rewarding shareholders. Eric joins us now for more. So, Eric, are we excited about the stimulus or are we worried it's too little, too late?
We're excited, Jonathan. I do think that this was a preemptive 50 basis points. We use this analogy with clients. The Fed acts as a personal trainer sitting next to the economic treadmill, and basically they've had to have that ramp elevated for some time. And so I think that what they're seeing is across the consumer spectrum, and your team has done a great job of covering this, is we're seeing that runner slow down, mostly with lower income consumers. And the Fed gets it. They understand that employment risks are actually going up. We used to have, for everybody looking for a job, 2 jobs available. We're actually about at parity right now. 1 job open for everybody who's looking. And the mix of those jobs, Jonathan, are not as robust. It's not as much tech and finance. It's more government, healthcare, and let's call it more GDP plus type of earning roles. So that is a message that we're taking as a bit of a preemptive move by the Fed, but also a bit of a trial balloon. The Fed isn't in a position where they have to massively cut. They can be more incremental. So again, that personal trainer analogy, we think will be a gradual easing as opposed to an abrupt one.
With that in mind, if that's the growth policy mix right now, do you think it supports an ongoing material leadership shift for equities, not just in America, but worldwide?
Yeah, I think it does, Jonathan, but I caution a couple of points just before I say here that broadening out is a good thing. One, we really look at data with respect to corporate IT budgets and where CFOs are spending money, not where they're talking about spending, but where they're actually spending. And that remains in things like big data, robotics, cyber, and of course, AI. So that's a phenomenon that we would not bet against. We think that as a relative return investor, which we are, you want to be at least market weight that category. I would say that with respect to the consumer, again, even though there are things like luxury goods popping on this China stimulus and what have you, that the broadening out is going to be still a very gradual one. One thing we're very encouraged by is what's happening in real estate. That's been the slow-moving train that we've all seen about to crash, but it just hasn't happened yet. The fact that both equities as well as real estate credit are hanging in there says to us the broadening is actually materializing as a decent thing.
Given the fact that you're somewhat optimistic and think that this is actually real, why are you going into long bonds?
Yeah, at least it's one thing where I'd say this, that, especially where we've been emphasizing long bonds has been in the municipal space for our taxable clients. That's a spot where we think that coffers from states and locals are in a decent spot. And actually, that is a yield curve that has uninverted first. So again, we are being rewarded by going a bit further out. I would say that our fair value for the 10-year is a little bit higher in yields than where we are right now. So we haven't been aggressive in government securities because we think fair value for the 10-year is closer to about 4%. So there has been, again, post-Fed, some initial buying of treasuries, but that has backed off. So we wouldn't be as aggressive in governments. We'd be more interested in things like structured credit, as well as munis, where those curves are a little bit more rewarding for us.
Okay, just go back to your analogy, because we've been full of wonderful analogies this morning as everyone tries to give people a sense of what we're doing. So the Fed's a trainer, the economy is on the treadmill, and the economy, the runner, is slowing down. Question is, are they a 25-year-old preparing for a marathon, or are they my age and, slowing down? So I'm wondering, at a certain point, do we end up, well, it's true, do we end up with an economy with a Fed that can go with rates going substantially lower? Or is this a Fed that can only cut so far before ultimately they have to worry about the other side of the equation, which is inflation?
Yeah, Lisa, probably not someone in their early 30s like you, probably someone in their late 40s, early 50s like me. But I think that this is, I'd say there's really a couple of runners on the treadmill, if you will. If we were going to Equinox or Crunch Fitness and kind of survey the landscape, you're seeing that bifurcation happen on a larger scale. So said another way, if you look at all the things that you've been talking about very responsibly, things like auto loans, things like credit cards, things like individual company data, the lower income consumer is certainly slowing down. I actually just came back from a 3-day stint traveling around Ohio, seeing our clients. People are very concerned about what may happen with respect to government policy. Now, I think, and Annmarie has done a great job of covering this, we don't have enough meat on the bone yet for a lot of certainty around policy and policy proposals, but people are concerned about, what should I do if in fact the economy slows down? Do I have enough in my personal balance sheet reserves to withstand it? So I think that there's some level, and you've seen this also in cash levels. It's been a tough conversation to get clients out of cash because they do provide some yield. But I think there is a level of trepidation, but that trepidation is not normally distributed. It's for middle income and upper income consumers. They're really not as concerned. Lower income consumers are saying, you know what, my personal balance sheet is a bit worse off than it was a couple years ago. I have to hunker down.
Okay, hold on a second, because this goes to the $121 billion that was added to money market funds in the past week, which is the most going back to March of 2023. There is now a record $6.4 trillion in money market funds, just as a lot of people are saying, get out of cash. How much is this directly because of the election? Because people are uncertain about what is going to happen and what the potential disruption could be.
Yeah, I think it's partial nostalgia, Lisa. I think that people are saying, hey, look, I finally have some yield in shorter term paper, so I want to stick there. They have to accept a lower return in doing so. And I think the reason for that, again, partially nostalgia, but also some trepidation about how things are going. And if you look at what we're seeing, just look at the 2-year. I mean, the 2-year has gone from 5.1% about 8 weeks ago down to 3.4, 3.5%. And you still have people stubbornly in cash. So I do think that sends a clear signal that the forward view is not necessarily the backwards view, that people realize that there's been a big pull forward in returns, and they're happy to take a lower return. And I think that some of that is trepidation around what's coming up in a couple of weeks. Look, I can send every chart and stand in front of an auditorium and talk to a client, and they'll say, hey, thanks for the elegant data, but I'm worried about right now. I'm worried about what happens 6 weeks from now because there's a lot of uncertainty. That's, I think, the bit of the compass of what we're seeing with clients right now.
Goldman and Christian Muller-Glissman said the same thing, just policy anxiety potentially putting a lid on things over the next month. Eric, how confident are you that this actually gets resolved in early November? How nervous are you that this goes on for a number of weeks?
Yeah, our base case is that there is a swifter resolution than we had last time around, which isn't going to, necessarily be earth-shattering from an analysis standpoint. But we have to keep in mind that, a lot of the state data is probably going to be more delayed in terms of what we see from counties. Look, there's been a lot of money and technology thrown at this issue, recognizing how high the stakes are. But we can't think that, look, we're going to wake up on November 6th and this will all be sorted out. So I do think that markets anticipate that to some extent. I'm not going to say there's a perpetual hall pass given, but I think that in terms of the bigger rock issues that we're focused on, our base case is for more divided government. Our base case is for more policy inertia. I think that the market is going to be at least happy with some level of clarity, if not complete clarity. But again, we're not 100% confident that it'll be resolved as quickly as it should be.
Eric, when you say swift, I'm guessing you mean within hours or days of the election. But what really gives you that confidence? Because we know that Georgia will be counting every single vote by hand.
Yeah, I'd say, Annmarie, likely swift measured in weeks as opposed to necessarily days or hours. And, and to my earlier comment, if you think about some of the counties and some of the seats that have had issues and had problems, we can't assume that that'll just be resolved, with a snap of a finger. So if you look at some of the real swing states and a lot of the great coverage that your team has done, we have to think that there will be at least a little bit of back and forth and gnashing of teeth, if you will. I do think that from an investor standpoint, recognizing the big ticket items that are in front of us, unless there is a shift towards more of a sweep for one part or the other in terms of all three branches, certainly that's not going to happen in the judicial branch, but within legislative and executive, that's probably in an environment where investors are okay if that sweep doesn't materialize. I think that where investors get concerned is if either party has that clear mandate, but it's unclear just again how fast it takes to resolve. That's more the issue for investors to think about if they buy or sell here.
Eric, we've got to leave it there. Have a good weekend, buddy. As always, big week next week. Payrolls just around the corner. Eric Freedman of US Bank Asset Management on the difference between Crunch and Equinox, which is, for those of you outside of America, sort of budget gyms versus premium gyms, $20 a month versus hundreds of dollars a month in some cases.
It's the one that either uses eucalyptus to scent the rooms in the locker, or you end up with something that is not scented.
On policy risk, let's get serious just for a moment. We can just for a minute. This came from Michael Purvis earlier this morning, so if you're just joining us, you might not have heard this. The real election risk is in December. I'll just share the first line of this research with you. The real election risk is not a blue or red sweep, but a narrow win by Harris, a win which becomes contested by Trump. That's the real risk going into year-end.
And it makes it much more difficult to have a real clear-cut answer a few hours or days after Election Day, given what we see going on in these states. Pennsylvania had an opportunity during their legislative session to start counting the votes as they come in, those absentee ballots. They can't. They have to wait for Election Day. Georgia is now saying that every single vote cast has to be hand counted. This is going to take a very long time, and you see both sides, especially the Trump campaign, lawyering up, preparing for potentially taking this to the courts.
Could go on for weeks and not days. Equity futures right now, things are all good. Nothing to see here. Equity futures just turning positive on the S&P 500 as we count you down to the opening bell, 1 hour and about 15 minutes away. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. New York City Mayor Eric Adams due in court later today. Adams is facing charges of corruption and taking illegal campaign donations. It's unclear whether the indictment is the last word on federal investigations involving the Adams administration. Federal prosecutors are believed to be leading multiple separate inquiries. Adams has vowed to remain in office, but Governor Kathy Hochul has the power to remove him if he can't perform his duties while fighting the charges. Meanwhile, Kamala Harris is holding a razor-thin lead over Donald Trump in key swing states. New polling from Bloomberg and Morning Consult showing the vice president leading among likely voters by 7 percentage points in Nevada and 5 points in Pennsylvania. She has a very small lead in Arizona, Michigan, and Wisconsin. Her lead is within the poll's margin of error, showing the election could be decided by the narrowest of margins or come down to a single state. And more than 1 million homes and businesses are without power after Hurricane Helene made landfall on the western coast of Florida last night. The National Hurricane Center warning the storm could still bring life-threatening storm surge, winds, and heavy rains across several southern states. That's your Bloomberg Brief. John?
Yahara, thank you. We'll catch up with you in about 30 minutes' time. Up next on the programme, the Morning Calls, plus Stephen Trent of Citi as Southwest announces major policy changes and a stock buyback. The conversation up next. The opening bell, 1 hour and 12 minutes away. Equity futures on the S&P 500 just turning positive in the last few minutes. We're up by 0.05%. Time now for some morning calls. First up, Morgan Stanley maintaining its overweight rating on Costco. The analyst citing strength across product categories and growing e-commerce momentum. Your second call from Citi raising its price target on Walmart to a street high, 98. The analyst citing increased confidence in the retailer's winning position in the near and long term. And finally, Bank of America downgrading HP to neutral from buy. The analyst citing margin erosion in the company's printer division. That stock is off by 3.6% in the pre-market. Let's turn to the airlines. Stephen Trent of Citi reiterating his neutral rating on Southwest Airlines as the carrier announces a stock buyback and new passenger policies, saying the move suggests that, quote, today's management team remains in the driver's seat. Stephen joins us for more. Stephen, good morning. It's good to see you.
Thank you, and thanks for having me.
Let's start with the premium offering over at Southwest. What's the shift here? What does it look like? And how does it compete with others in the market?
Yeah, great question. So I do think that the premium that you're going to see from low-cost carriers is not going to be the same that you'd find on a Delta or United. So post-pandemic, there is an urgent push, I would say, from discount airlines to at least start to penetrate this market. And given the structural adjustments that have occurred since COVID-19, unless your name is Delta or United or maybe one or two others, you've been in a tough spot, and there has to be a way of generating more unit revenue.
So is this basically setting the bar really low? You get a seat if you pay extra, and actually you get an assigned seat that you don't have to wait in line. Yay. In Frontier, you get to pay for your can of soda. Is this basically the path of travel?
Somewhat, yes. And we're not going back to the pre-pandemic period where you had a lot of high block hour utilization, and we had adequate air traffic control capability, where if you were a low-cost airline, you win that battle on having the strongest seat mile cost profile with having a lot of flights every day. If you're a network airline, you're never going to win the seat mile cost battle. You win the battle on strong unit revenue. Today, with all the cost convergence that's occurred, we don't have the FAA capability. Air traffic control shortages in some places. There has to be some kind of push to premium. And I think for the low-cost airlines or discount airlines, there's a limit there.
So why aren't you more positive on this stock? You're maintained your neutral. Why are you still skeptical?
So I think, are they doing things that are going to help move the needle in terms of earnings and profitability? Yes. But when we look at what they said in yesterday's event, on a long-term basis, $4 billion in incremental EBIT, that's fine. And they're talking total free cash flow of maybe just over $1 billion by 2027. So when one looks at the EBIT to free cash flow conversion, that's actually pretty weak versus where it was pre-pandemic, where in each case you kind of had 3 and 3. So there's a big earnings quality issue here, even as we're getting that large incremental EBIT number.
How did they capitalize on the CrowdStrike outage?
Sure. So you had some demand spillover, from Delta and others. That
Are those customers sticking?
I think that's hard to say, and I would say no, if I had to take a guess on that. People had this a lot of travel disruption from this massive outage, which in Delta's case, for example, led to thousands of flight cancellations. You look at some of the other carriers, some of them didn't have much capacity to pick up extra passengers because their flights were already full. And July is a really good month for unit revenue. Some carriers did have capacity to take some extra flow. So I would say that's probably going to be temporary.
What I find fascinating about the airline story right now is that it is the perfect microcosm of the haves versus the have-nots. Basically, the people with money, able to spend, able to pay for premium, those airplane carriers are actually doing really well. They're able to capitalize on that. Those trying to cater to lower or middle income families going on trips, they're really struggling. How much does that really reflect the difference that you're seeing in the fates of these different populations?
Yeah, look, I think that's important. And if one looks at some of the discount airlines, for example, that maybe pre-pandemic catered to nonprofit people going on trips, college students, I'm not saying that travel's gone. But when we look at what happens economically over the last couple of years, interest rates have been very high. Maybe some of those folks are traveling less because they're unfortunately falling behind on other things. But for folks that are doing more blended travel, post-pandemic, many are no longer in the office 5 days a week. So that has changed travel patterns, consumer behavior, including the way consumers purchase tickets. And a lot of those folks still have money. And in some cases, the travel that they're doing is at least partially on their employer's dime. So absolutely, there's a purchasing power difference when you look at the models.
2 quick questions. First, top pick right now. What's your top pick at the moment?
So Delta is our favorite one of the U.S. airlines. I would highlight we have United Airlines on Citi's focus list.
Big rally over the last 3 months. Final question, most important one. Like to know, the most disruptive part of traveling, I think for a lot of people, I'm speaking for myself, I know, but many of you share this, boarding. What are they going to do with baggage fees? This happens every single flight we go on. There are too many bags going on board. They're trying to find a space for them. Are we moving from a model where they're about to start charging us for carry-on? How close are we to that?
So I think on a widespread basis, that would cause a lot of disruption. So you can see in the case of checked bags, that's already can
Big
be a
issue.
headache. Yes. I would say on a widespread basis, starting to charge for carry-on bags seems a bit extreme versus the price point that most people are boarding flights these days. So I'd be surprised to see
don't
that.
you have the same problem every time?
Yeah.
Trying to find space for the bags.
Well, and this is the reason why people rush to get on and why people get pretty aggressive to get on first so that they can get their bag up there because there's limited space. And otherwise you could end up with it under the hood and then you've got to wait for it.
They put in the call at the gate and they're like, we'll take your bag for free. No, you need to pay for this. If you want to take my bag away from me, which I am using as carry-on because that's more efficient, effective and quicker, you need to pay to take that off me.
Well, you can tell them that. They might say to you, okay, well, then we'll make you pay for your carry-on.
I would happily play a supplement. Honestly, it would it would quicken the whole thing up.
Well, it would also make it more civil rather than have people
Totally.
basically pushing each other out of the
I
way.
see John holding on for dear life on his carry-on as he boards his next flight.
It makes me anxious walking past those guys at the gate. I'm like, they're going to take something
You got
off
to
me.
hide it.
Yeah.
Go for boarding group 1. Boarding group A. Try and be in the...
Exactly.
Try and be a man with a suit in group 1. they still try and take the suit off you. We'll have this conversation in the break. Stephen Trent of Citi, thank you, sir. PCE data up next. Don't worry, I understand. Group 1 carry-on problems, first world problems. I get it. Equity futures on the S&P 500 positive by 0.06%. On the Nasdaq up by 1/10%. PCE data just around the corner. Mike McKee's in the studio. He'll break that down for you. Going into it, the scores in the bond market look like this. 2-year, 10-year, 30-year. The 2-year yield down 2 basis points, 360.82. The 10-year down 2 basis points at 377.53. As the economic data begins to pour out, let's cross over to Mike McKee. Morning, Mike.
Good morning, John, and good morning, everybody. We have some disappointing news on personal income and spending, which is a little bit of a surprise given yesterday's revisions to GDP. Personal income up 0.2%, down from 0.3 the prior month, and spending is up only 0.2. The forecast was for 0.3. It was 0.5 the prior month. So we have a bit of a disappointment there. But in terms of the inflation numbers, they come in as expected, up 0.1% for the headline number, and a year over year, and the core is up 0.1% as well. 2.2% on the year over year for PCE price indexes. That's down from 2.5, lowest since 2021. 2.7 is the core, goes up just a tick, but base effects there comes in on a month-over-month basis, a little bit lower than anticipated. So at this point, we are in a position to restart the debate. 25 or 50.
We'll have that conversation in just a moment. Let's turn to the price action. I can tell you that slight downside surprise on core PCE unlocks a bit of a rally at the front end of the yield curve. We're down 4 basis points on a 2-year, on a 10-year down 4 basis points. Also, equities still higher by 0.1% here across the board. In the FX market, euro dollar coming back to about 111.72. So a bit of dollar weakness off the back of this move. Let's talk about this move. Core PCE, just a small downside surprise. It reminds me of something that Kelsey Berrow of JP Morgan Asset Management said on this program just yesterday. The importance of PCE and inflation for the 25 versus 50 debate. I think we've become very preoccupied about the importance of the labour market, but based on some of the guidance we've had from Fed speakers recently, particularly Governor Waller, maybe this inflation report is equally as, or perhaps even more important than payrolls next Friday. This is what Kelsey Berrow had to say. Downside misses on upcoming inflation reports could be enough to keep additional 50 basis point rate cuts alive.
I'm so glad you went there, because to me, look at this data, and basically you're not seeing wholesale weakness, so it's good for equity markets, but it does open the door to a 50 basis point rate cut, which is now being weighted much more heavily in the Fed funds futures, just to put that out there. As people take a look at ultimately, John, you're going to have a Fed that is going to be more accommodative because inflation does not seem like a threat.
Just reminds me something that Deutsche Bank said recently. The 25 versus 50 debate was never about NFP. The case for 50 rests on policy rates being comfortably above a conservative upper bound of neutral. Front-loading the first 75 to 100 of rate cuts is relatively easy. Do we start to lean into this 50 just a little bit more after this data? I know we've still got payrolls next Friday, but you just wonder, Lisa, what the conversation sounds like through the weekend and into next week.
Well, right now the market is speaking pretty loudly, and the market is screaming that, yes, it is more of a consideration to go 50 basis points, because why not? If you don't have an inflationary risk, and ultimately that is the main if, then why shouldn't the Fed normalize, recalibrate at a more accelerated pace, given that you aren't seeing green shoots necessarily under the labor market? And you could see that the preeminent concern is preventing further weakening.
Let's continue the conversation. Joining us now is Dana Peterson of the Conference Board. Dana, welcome back to the programme. Got lots to talk to you about that consumer confidence number from earlier this week. I just want to pick up on the data that came out just moments ago this morning. How are you thinking about it? How does it inform your view of where the Fed goes next?
Well, I think the jury's still out. We still have a lot more data we need to see, especially next week's employment data. But, I mean, the good news is that inflation is continuing to slow, and so the Fed can be less concerned about that. If inflation slows faster than the path that they outlined in the September SEP, then certainly they can go 50. But again, I think they need to see the labor market. I think the labor market's doing fine. When we look at the number of payrolls, you don't need to have 300,000 payroll additions a month when you're pretty much at full employment and the unemployment rate is very low. Wage inflation is still elevated. So there's still a lot of good news about the labor market. And also when we look at growth, if consumers continue to spend, then that's going to mean very strong GDP growth. So I think the Fed is still going to be data dependent. And, all the data from now until November are going to decide whether the Fed goes 50 or 25.
Well, Dana, how low is the bar to go 50? We've got payrolls next Friday. The estimate in our survey is about 130. You said yourself, we don't need 200. Something between 100 to 150 is still OK for the economy and where we're at right now. How low is the bar to go 50?
Well, I think if you start seeing negative payroll reads or further creep in the unemployment rate, the Fed's looking at the unemployment rate to kind of top out at 4.4%. The natural rate is 4.5%. So that's still employment. But I think if you start seeing the unemployment rate creep above that, then the Fed is going to lean on, okay, now some of the downside risks that we feared are starting to materialize. So we need to cut rates faster to undergird the labor market.
Were you surprised, Dana, by how weak some of the labor sentiment was by the consumers that you ended up surveying? Were you surprised that people felt like jobs really were getting much harder to get?
Well, not really, because if you think about it, the peak of the jobs hard to get, jobs easy to get differential was back in 2022, when we know it was very easy to find a job. You had all these job openings because companies were still trying to replenish their ranks after the pandemic. Now, companies have pretty much have all the workers that they need. When we talk to the CEOs of large companies, about 40% of them are saying, we're not making any changes to our workforce, and the other 40% are saying we're going to continue to hire, and only about 20% are saying, well, maybe we'll let some people go. So it's still a story of hiring and hoarding. And so if that's the case, then you're not going to see big payroll gains month after month because we're at full employment.
We also saw a decline in consumer sentiment just more broadly. And previously, it had been really inflation expectations that were driving that. When people felt like the cost of the goods they were buying were going up at a dramatic pace, they felt pretty bad about that, pretty negative. Do you think that this had more to do with the jobs picture maybe softening from a very strong level? Or do you think this has more to do with things like the election and other sentiment factors that come into some of these economic points?
Sure. Well, the measures that go into our headline are business conditions, the labor market, and income. The election or inflation, those measures don't fold up into the headline. And certainly when we look at the headline, it really has been moving back and forth. Certainly the last reading was at the bottom of the range that we've seen over the last 2 years. But certainly we do ask consumers, what do you think about inflation? What do you think about, things that are impacting the economy? It's still the case that prices and inflation, those two words, are still cropping up. Prices, the level of how much things cost is elevated, but they're a little less concerned about the rate of change in inflation. We did notice that the words interest rates and election did pop up in some of the write-in measures, but even still, when we looked at the election, certainly over the last years in terms of those write-ins, it's still pretty low. I think consumers are not really going to get too focused on that as being a major issue for the economy until we get to October.
But to Lisa's point, and I understand you have a surgical way of how you go about this survey, but you talk to CEOs, you see what's going on in the campaign trail right now. If you're a CEO and you come out and say potentially you might be moving workers to a different country because you need to save money or you need to find certain labor, you are going to be basically in the bullseye of one of these candidates. Is there a concern potentially in the labor market that companies are just waiting for more clarity after November 5th?
Yes, companies are waiting for more clarity, but the things they are investing in include technology and human capital. And it's really not the case. We're not hearing that companies are looking to offshore people. They're trying to find people right here in the U.S. And certainly the companies that are benefiting from industrial policies around tips and infrastructure and factories are doing quite well. They're giving us a good story. Now, it's the companies that are more consumer-facing where they see, risks of consumers really pulling back. They're much more worried, especially since consumers are still buying a lot of services. But we're noticing that as goods prices fall, consumers are running out there and they're buying cars. So we're not getting that sense that companies are either looking to lay off labor or even move them abroad. It's a very different story.
Dana, I'm pleased that you joined the programme today because I'm sure you got a lot of phone calls this week. Dana Peterson there at the conference board on the latest in this economy. Equity futures right now, about 50 minutes out from the opening bell, positive by 0.2%. Session highs. For a second look at the data, Mike McKee, what do you see?
Well, here's one number that's really impressive, and it's going to change some people's minds perhaps about thinking because of the revisions we had to GDP. The personal savings rate for the month, for the most recent month, is 4.8%. In July, 4.9%. In June, 5.2%. Now, these numbers back before yesterday were 2.9, 3.1, 3.3. So the savings rate has gone up by about 2 percentage points in each month, which means Americans have a lot more money in the bank still they could spend. Also, driving the incomes this time were a 0.5% increase in overall wages and salaries, which is fairly strong. So people are getting money. People have money in the bank. The forecast for the economy slowing, I'm not sure if people are going to stick to that.
I'm so glad you brought up that savings rate. I thought that was fascinating how much it was revised up in some of the backward-looking revisions. Basically, people haven't used up their cash as much as people previously thought. Does that mean, in some ways, this was just inflation that faded with some of the year-over-year comparisons post-pandemic? Or does this speak to maybe that we are understating some of the strength and therefore the inflation risk in the economy?
Well, it's a combination of both. Obviously, inflation's fade has helped, but it's been hard for the government to measure the economy, as we've seen with the Fed. And so they do these updates, these revisions once a year to GDP to try to bring everything together. And what they've ended up doing is revising gross domestic income up significantly. And that's bring the two things, gross domestic product and gross domestic income, much closer together. And that explains a lot of what's been going on here. The interesting thing, too, when you look at the overall inflation rate for the months, we're running at about a 1.7% for the last 3 months for PCE headline. And remember, the Fed's target is 2. So for the last 3 months, we've been under what the Fed's targeting.
I thought we had to spend some time below it now to balance things out for the amount of time we spent
That's
above.
actually not true.
We're not doing that anymore.
No,
we moved on.
They never did that.
Okay.
But everybody thought
we introduced
maybe
that.
they would. Yeah.
We introduced that plan just before
I asked
inflation
Jay Powell
took off.
about that out in Jackson
That worked
Hole.
well,
He
didn't
said,
it?
we're not ready for that, to make that decision yet.
Mike McKee, defender of the Federal Reserve. Let's get to this bond market. Yields down by 3 basis points on a 2-year right now, 3.59. On a 10-year, down 3 to about 3.77. Mike Contopoulos of Richard Bernstein Advisors joins us now for more. Mike, welcome to the programme. Here's the debate. On the one side, inflation is coming down. Jobs growth is decelerating. On the other, the Fed is cutting interest rates and China is easing. And we get a lot of people on the programme confused about what to do in the bond market. Should yields be up or should yields be down?
Well, I think the bond market is actually giving you a pretty good signal right now. What did it do when the Fed cut interest rates last week? You had the long end actually go up and the front end stabilize and go down a little bit. And that's suggesting that, as the Fed eases policy here, as lending conditions ease, employment is still strong. Profits are still accelerating. China is now easing. It all likely leads to longer term growth and inflation expectations. And don't forget, on the inflation front, although everything we've seen, there's no doubt about it, everything we've seen has been positive of late, the comps are going to start getting harder as you get later into this year in early 2025. So some of these very low prints, certainly on a year-over-year basis, may not be sustained. So I think the bond market's actually telling you the answer to your question, which is longer term growth and inflation may actually be higher than what's expected, but there's obviously a tendency to central banks wanting to cut. And so I would expect further curve steepening here and modestly lower front end yields.
So, Mike, just talk to me about the long end. What kind of numbers are you thinking about? 3.75 right now on 10s, 30 still in and around 4%. What kind of numbers should we be thinking about, reconsidering?
I think we're in a range-bound market. I don't think, 10s are going back up to 5 or anything of that nature. I think you're going to live, for the most part, between 3.75 and 4.25, maybe 4.5, depending on what happens on growth and inflation later this year and into next year. That wouldn't shock me one bit at all. Obviously, the trend has been, higher, getting towards that upper 3.75 to 4% range. And I wouldn't be surprised if it breaks 4 at some point in the next few months. But I don't think we're going back to 5, and nor do I think we're going to 3. I think we're going to be pretty range bound. And so what investors should be thinking about is as you get below that 3.75, 3.7 level, you're probably supposed to fade interest rates at that point and duration and interest rate risk. And as you get back towards above 4, 4.25, probably be, adding it back. And I think that range is going to be where we live until there's more clarity on the direction of growth. And that's the most important thing from our perspective.
Mike, it feels like you're pouring a bit of cold water over some of the glory and the celebrations that we've been hearing from so many people over the past week. We've been talking about soft landing nirvana. One viewer wrote in saying it's global Goldilocks. Why are you pushing back against that and saying don't be a hero?
Yeah, well, when I say don't be a hero, I'm really talking about credit risk in that case. On the equity side, I actually think there's tremendous opportunity. Small caps, look at the futures this morning. Small caps, this is kind of Goldilocks for them. Accelerating earnings growth, Fed that's easing policy, so interest rates are not going to go up a ton. And so for some areas of the market, particularly in equities, I would argue, Lisa, that it is a bit of Goldilocks, and small caps being the best, the beneficiary of that. On the fixed income side, credit spreads are incredibly tight. And when credit spreads are tight, all of your return is effectively coming from the interest rate component, not from the credit component. So even though theoretically we should love credit risk here, right? Accelerating earnings growth, easing monetary conditions, maybe stronger growth than what's expected. That should be very, very good for corporate profits and for credit. But the spreads just don't compensate you for any sort of risk. And at the end of the day, we are probably later economic cycle. And so I'd much rather own, decide where to own my risk rather than just overweight credit risk. So something like CLOs, for example, which offer you quite a bit of spread, makes a lot more sense to us than the investment grade market. So it's more about finding the opportunity than not liking, risk at all.
Mike, I love this, and it's so interesting to hear you say this as someone who I followed for a long time from your days back covering the high yield market at Bank of America. I'm curious about how much you've seen the high yield market be transformed in some ways, the public high yield market, from a canary in the coal mine to something that is very separate, that trades on very different fundamentals and technicals.
Yeah, the high yield market's been really interesting lately because if you look at, let's say, like triple C debt, for example, it's a completely different market than the rest of the market. One of the things that I would argue is very encouraging about high yield at the moment is that you haven't really had the pickup in default rate. Our default model actually suggests defaults are likely to decline over the next 6 months on an annualized basis and get back towards 2%, which is a very, very low default rate in normal times. But you're absolutely right. I mean, there's all sorts of things going on at the high yield market. There's a lot of innovation out there as well with ETFs, and that's transformed the liquidity of the high yield market to some degree and what you can do there. That's sucked liquidity out of other areas of the high yield market that maybe don't have ETF, where the bonds are not in the ETF. So there's all sorts of things to do in high yield from a liquidity perspective, from a risk perspective. But the signals coming from high yield, I actually think, are very encouraging about the broad economy and lending conditions. But again, the spreads don't really excite us as far as being an opportunity in high yield. Again, why own high yield when you can own 8.5% triple B CLOs?
Mike, just before you go, just a final question. Given everything you've just said, where do you and the team see rates year-end next year, 25? What kind of number have you got on Fed funds?
I know, Jonathan, you love to pin me down on a number here. I don't think... listen, I think there's a lot of volatility that can happen between now and then and a lot of return that can be made. And quite frankly, by the end of next year, it's going to depend on, are we in a reacceleration? Are we in a recession? And I think both are almost equally plausible. So listen, if you're in a recession, I think rates will go as low, 10-year will go as low as 2.5%. If you're reacceleration, you could probably see that 5% handle again. And I don't know which one it's going to be. And I think that's okay. I think really trying to make a call 15 months out is pretty difficult. It's hard enough over the next 3 to 6 months. So not to punt the question, but I'll punt the question.
No, I hear you, but I can come back. If you think that both are equally probable, you can make the suggestion that one is more priced than the other, can't you, right now?
I think that's a fair statement. Although we are kind of splitting the difference right between that 2.5 and 5. So I guess the market is actually giving you that 50-50 odds right now. 2.5 on the long, if you have a recession, 5% if you have reacceleration, 50-50 chance. What's in the middle? 375. So market, I guess, is pricing right now equal odds of either of those scenarios.
Smart, Mike. As always, appreciate it. Mike Contopoulos there of Richard Bernstein Advisors. What do you make of that?
Basically, no one wants to make the difference between the two, and their tail risks are both feeling equal and completely diametrically opposed to one another. That's where we are.
Things are pretty finely balanced at the moment. Let's give you an update on news elsewhere this morning with your Bloomberg brief. Here's Yahira Heckers. Hey, Yahira.
Hi, John. Recapping that data we just got, the Federal Reserve's preferred measure of inflation rose modestly in August, underscoring a cooling economy. The core PCE index, which excludes the volatile price of food and energy, increased 0.1% from July. Analysts in our survey were calling for an increase of 0.2%. The year-over-year data for core PCE came in line with expectations, holding at 2.7%. Meanwhile, Intel apparently turned down ARM Holdings when ARM asked about buying a unit of the company. Bloomberg has learned ARM approached Intel about buying the chipmaker's product division. Intel's response? It's not for sale. Intel was once the world's largest chip maker, but has become the target of takeover speculation amid a rapid deterioration of its business this year. And Bitcoin is on track for one of its biggest September gains in history. The cryptocurrency is up more than 12% this month, compared to an average decline of 5.9% every September over the last decade, according to data compiled by Bloomberg. Global rate cuts this month helped bid up everything from stocks to gold and crypto as investors bet on more stimulus ahead. That's your Bloomberg brief. John?
Yahira, thank you. Thanks for this morning. Have a great weekend. Up next on the programme, setting you up for the week ahead. You're watching Bloomberg TV. "37 minutes away from the opening bell, equity futures on the S&P 500 firmer by 0.1%. Your trading diary, the calendar for today and the rest of next week. Fed Governor Bowman speaking this afternoon ahead of more remarks from Fed Chair Jay Powell on Monday. Tuesday, we'll get jolts in ISM manufacturing and earnings from Nike after the closing bell, plus the first vice presidential debate at 9 p.m. Eastern Time. Wednesday, ADP private payrolls. Thursday, another round of claims. Friday, the big one. Payrolls Friday just around the corner. Mike McKee is still with us. Mike, let's talk about next week. What are you looking for?
Jobs day. Well, we'll look for Jay Powell. And I think if you look at today's numbers, if the Fed were cutting or meeting next week, they'd feel great about cutting rates. Unfortunately, they have jobs on Friday, which will be big. And they've got another jobs report plus another PCE report before their next meeting on November 7th. So we can't say for sure what's going to happen. But at this point, we've put 50 on the table again if the Fed wants.
We've been done with the quiet period. We've gotten a lot of Fed speak. Is there any conclusion to John's point earlier about whether the jobs number really is going to be the most important in determining 25 or 50? We get to do this again. Or is it going to be really just simply that inflation is coming down?
Well, I think the timing of the calendar puts jobs in the first place because we get the jobs report for October on November 1st. It's the last major indicator before the Fed meeting on November 7th. The CPI report comes out October 10th, and then October 31st is PCE. So the last number that people are going to be looking at is the jobs number, and we'll see whether or not it pushes the Fed one way or another. We should get an interesting set of comments from Jay Powell on Monday, though, on how he's thinking about all this.
I feel like I'm the only one around the table that's actually interested in the vice presidential debate next week. And I say this, though, because today in our swing state poll, voters continue to give the national economy low marks, with nearly 7 in 10 saying it's going off on the wrong track. Yet you just read through a slew of numbers that said we're actually going down the right track.
Well, that's been a problem for the Harris campaign. It's been a problem for the Biden administration is people don't feel this. It goes back to the old vibe session comment. People are still feeling that things are not good, and the numbers contradict that, but it hasn't gotten into their lived experience yet. Now, food prices have flattened out. Gasoline prices have gone down. Maybe in another month when we get to Election Day, it will have changed people's mind. Of course, half the people would have voted by then, but it's got to be something that gets through to them in their own day-to-day life.
Mike McKee, Thanks for this morning. Appreciate it. Really do. Equities right now on the S&P still positive by 0.1%. Your lineup for Monday: Brian Weinstein of Morgan Stanley, Chris Harvey of Wells Fargo, Maya McGuinness of the Committee for a Not So Responsible Budget, and Kathy Jones of Charles Schwab. All of that on Monday morning. Have a wonderful weekend. What a week in this market. Equities at all-time highs from New York City. This was Bloomberg Surveillance.